that has created this uptick in gold despite a stronger dollar. Normally, you would look at the fundamentals today and you would go, oh, gold should be going down. Real rates are higher, dollar is stronger. Those are all the dynamics that put downward pressure on gold. Instead, gold's going up. What's driving it is that strong demand coming out of these emerging markets where they're now recycling into gold as opposed to U.S. Treasuries creating that dollar recycling theme. So this still has more legs to it. You know, we see more upside in gold prices from here.
I guess, Jeff, what we're trying to get at is there are some stories that people have been banding about all year, whether it's the EV transition or some of the grid build out that's going to require more copper usage, whether it's some of the central banks shifting more to gold. Why do they have so much further to go if it's a lot being priced in and speculators coming in and trying to get ahead of them and bidding it up even further? What gives you a sense that there could be a catalyst for another leg higher in the near term?
Because you need to destroy demand. Right now, you're running on fumes of very low inventories, particularly of copper. You have no way to bring on new supply. Once you're out, when prices began to spike, they got to spike high enough to bring demand back in line with supply. That's where we're going to find out where that elasticity of demand really exists. The only one we can ever observe is going back to the 1960s, which suggests maybe it's 15,000, but we really don't know. We're going to find out. We didn't find out in the 2000s bull market because China was never forced into a situation where it had to consume and you had to ration demand out. That's why we peaked out in that $10,000 a ton range, similar to where we are right now. So going forward, no inventory. Remember, really strong demand from all those sources you talked about. There's not enough to go around. Somebody's going to have to drop out, and that's where we're going to find out where the high print is on this market.
Jeff, if I could just go back to your answer earlier on the oil market, and you see this very bullish market happening, and you see potentially we're not even at peak driving season. If we do see gasoline prices in the United States go past $4 a gallon, are you expecting the U.S. to tap the SPR?
Yeah, but there's a lot of other levers they can pull to put downward pressure on oil prices. That's why I'm far more bullish on base metals, copper, than I am on oil, particularly until you get after the election. Because when you look at what drives elections, what drives the populist focus, it is the economy and inflation. So keeping oil prices and gasoline prices under wraps over the course of the next 6 months, I think is going to be critical to the administration and the government. And we've seen this play out election after election. So I can't see why this one would be any different. What does that limit, on oil? It means you can get up into the high 90s. Maybe, you could top over 100 or something like that in the midst of the cooling season. But, would it be lasting? No, it's not like the underlying copper story, where it doesn't really impact the underlying inflation. Now, you throw in something like some surprise problem in the Middle East or something like that, that could open up the upside. But I think, you're going to see governments around the world doing everything they can to fight this. And one of the ways is, turning a blind eye to, sanctioned oil, sanctioned products. So there's a lot of methods other than tapping the SPR that can be used to, also relaxing environmental regulations. We've seen them use that in the past as well. So there's lots of tools at their disposal.
Jeff Carey of Carlyle, thank you so much. Keep wearing that, copper bracelet until you hit 15,000 or bust. Thank you so much. Brian Levitt of Invesco, thank you so much for waking up early and joining us here on set. Coming up next, Emily Rowland of John Hancock Investment Management, Joe Feldman of Telsey Advisory Group, and former NEC Director Gary Cohn. This is Bloomberg.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Just looking at your portfolio of businesses, it is about resilience. It's about pressure. It's about women. How does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after
after I retired was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Consumer is in a weaker situation today than a year ago.
Consumers are feeling the pinch from inflation. They're starting to lose purchasing power again.
The upward pressure on inflation is just really strong over the next several months.
We've all been asking for the last year and a half, when does the consumer slow down? I think we're seeing some of that.
In the end, when it comes to the fate of the economy, it's not about the consumer. It's about whether companies make money.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Is this still the pivot party as we wait for that disinflation? From New York City, for our audience worldwide, good morning. This is Bloomberg Surveillance. Anne-Marie Hordern. I'm Lisa Abramowitz. Jonathan Farrell will be back in his seat tomorrow saying good morning, good morning. Right now, we're looking at a market that's looking for direction at a time. We're awaiting a couple of very important data dumps, including PPI that comes out in about 90 minutes' time. How important, Anne-Marie, are some of the data that we're going to be getting and is heading into CPI and retail sales tomorrow to really determine whether we've reached this pivot point for inflation into a more directly downward trend?
And then, of course, the PCE, which is what the Fed looks at. And we're going to be hearing as well from Jay Powell today. So potentially he'll be able to talk about the data from the PPI. What we're seeing in the Bank of America survey today is that wages on interest rate cuts have sent investor optimism to this 2.5-year high. People are still expecting at least one for the second half of this year, Lisa.
And how much is that really driving things? And that's the reason why when we spoke to Emily Rowland a couple of months ago, she said, this is a pivot party. Join the pivot party. We're going to be speaking with Emily Rowland in just a bit and really ask her that question. Is that essentially what's upholding some of the investor optimism, which is the greatest going back to some 2021 at a time where earnings are coming in a bit light? We saw that from Home Depot this morning.
And also we're going to get Walmart, which I think is going to be key to, on top of the retail sales numbers, on how strong this consumer actually is. And what are you potentially seeing in terms of the inflation story? Look at the ISM. When you look what the businesses are saying, they still say that they see inflationary pressures in their pipeline.
Which is a reason why we saw that New York Fed survey come out yesterday, kind of reiterating what we saw in the University of Michigan sentiment survey on Friday. People seeing that 1 year out, that 3-year forecast of inflation creeping higher at a time where Housing prices are expected to go up. Other goods, we're talking about copper and Jeff Curry's copper bracelet. There is that sort of inflation aspect of the day. There's also the policy aspect of every single conversation you have with any investor, especially at a time where tariffs are coming out. We did finally get those tariffs from the Biden administration. Anne-Marie, we talked about how, not really surprising, this has been highly telegraphed. Headline number came in as far as what we're expecting. Did we hear about how this was going to be implemented and what's to come next?
Well, the headline number, $18 billion. But we're talking about inflation. Tariffs are inflationary, but it does seem like this is specific to certain sectors. It's going after those certain sectors that this administration has also been focused on from their own industrial policy. And you look at the likes of EVs, 25 or 27.5% tariffs on a Chinese EV coming to the United States. There's not a single Chinese EV in the United States right now. Well, they're boosting that to 100% in terms of that tariff. But okay, that sounds like a big deal, but what difference does it make? It's not tangible. So I think what a lot of these tariffs show is what Terry Haynes said to us yesterday in Washington, D.C., is it's symbolic of where the direction of travel is when it comes to Beijing and Washington.
And how much this is going to be inflationary is something people are definitely trying to parse through, and which areas stand to benefit in the United States. Right now, markets kind of searching, again, as we said, for direction. Yesterday, not much action. Today, neither, although not exactly a negative kind of read at a time where we are getting the last gasp of earnings and ahead of the inflation data. In the yield space, very much front and focus for me. Again, not a lot of action, 447 on the 10-year, but the path of travel is really important to look at. We're down from a high of 470 on April 25th. It really just, again, reiterating this question of how much has the Fed underpinned optimism, both at the corporate level as well as the investor level, with the idea that they do want to cut rates in the near future. Coming up, Emily Rowland weighing in on that of John Hancock as traders await that U.S. PPI data. Joe Feldman of Telsey reacting to Home Depot's disappointing results, and former National Economic Council Director Gary Cohn as the U.S. imposes fresh tariffs on China. Let's begin with our top story, stocks on pause ahead of U.S. PPI data. Emily Rowland of John Hancock writing this: if the streak of softer economic data persists, markets may be priced for too much optimism on the earnings front. Emily joining us now. And Emily, I want to start with the pivot party that you talked about. You were heralding that pivot party, talking about how things were getting out of control. Are we still kind of seeing that, or in some ways a resurgence of that, with this idea that investors are confident that Jay Powell wants to cut rates?
Yeah, Lisa, we're still in the pivot party, I would say, and Chair Powell's been the lead bartender on this. You know, starting last fall, just the idea that rate cuts were coming spurred this risk-on rally that was picked up by momentum investors, and he just has not deviated from that dovish message. So as much as you loosen financial conditions, then you're seeing, again, this party taking place. I would say the one thing that's maybe causing people to go home are these whiffs of stagflation that we keep seeing. So it's little things like in the Michigan sentiment survey that you just mentioned, seeing inflation expectations picking up. Some of the business surveys we look at are suggesting that demand is slowing at the same time where prices paid is moving higher. It's tough to say we're in stagflation right now. Atlanta Fed GDP estimates for this quarter over 4%. We're looking at unemployment less than 4%. Core PCE, which of course is the Fed's preferred measure of inflation, has been coming in around 2.8% year over year for the last several months. But markets are starting to trade like we're in stagflation. We're seeing areas like defensive equities and value stocks catching up to tech and communication services. That's where the best earnings have been. But we're seeing this rotation starting to play out as stagflation becomes a bigger theme.
Are you following that? Or do you kind of push back and say, we are seeing 4% GDP growth? Things aren't stagflating. This is just an issue of things slowing exactly by design by the Fed policy.
Yeah. Well, we're still looking at this through the lens of factors. So in this environment, we still like quality stocks, ones with great balance sheets, tons of cash. You want to own that in an environment where maybe we are higher for longer. We don't want to own companies that have high interest burdens. The challenge is a lot of people like quality stocks. So they've run up a lot. They are overbought in our view. We still like it. They've got the best fundamentals. I mean, just look at earnings season. Tech, comm services driving the bulk of it up 20 to 30%. Without the Mag 7, S&P 500 earnings have actually come in at negative 2%. year over year. That's the 5th consecutive quarter of negative growth. So we want to own those companies, but we've got to diversify away from that, owning some stuff that's cheap. And you're finding that on the value and the defensive side. We like utilities. We like areas like healthcare that are really helping balance the valuation risk that we're seeing in quality.
When you look at potential evidence of stagflation, the market is trading as though we're in it, but you're pointing to key economic indicators that say we're not. So how do you see this story playing out?
Yeah, I think eventually what we'll see happen is rates are going to chop around here as we're kind of oscillating between growth concerns and inflation concerns. As long as you see inflation continuing to moderate, you see growth slowing, and we can do it at this kind of very moderate level, I think stocks are going to celebrate that. You're going to see yields come down. I mean, Lisa mentioned, we haven't talked much about this. We just saw the 10-year Treasury yield drop about 25 basis points in 2 weeks. That is an environment that's favorable for equities for now. But if we start to see a more precipitous decline, say initial claims spike again, that was a big spike last week to 231,000. Maybe there were some statistical anomalies in the data. We'll have to see. But if yields start to fall more precipitously, to us, that's going to signal that, yes, there's relief on the inflation front, but something's not going that well on the growth front. So we've got to be mindful of that. In that environment, of course, you want to lean into bonds and take a little bit of risk off the table.
Are markets priced for too much optimism when it comes to earnings?
Well, the challenge, Anne-Marie, is not this earnings season. It was pretty good. Earnings came in around 5%. The challenge is going forward from here. So when we look at what analysts on the street are penciling in for Q2, it's 10%. For Q3, 8%. For Q4, a whopping 17%. So if we continue to, again, to see a moderation or a softness playing out in the economic data, that probably means that there's a bit too much optimism baked into earnings. Now, of course, you can find opportunities underneath the hood, but it's going to be really, really important to really follow those stories and find those companies that can generate the best earnings from here.
Emily, it's been a whirlwind for the surveillance crew. We've been in Washington, D.C. yesterday. John's over in Paris, talking to different people. Yesterday in D.C., very much front and focus was the deficit, the federal deficit, how much to worry about it. I'm not going to ask you about that. I'm more interested actually in where the money is going. You're welcome. Where the money is going in terms of why this spending has been going on in such a robust way. How much are you following the money, the fiscal expenditures that are going to companies that still have yet to be spent? Particularly in the chip sector, particularly in some of the industrial complex?
It's a great question because right or wrong, it's happening. And we're actually increasing the size of the deficit with the unemployment rate below 4%. This is pretty wild. There's not much precedent for this, but right or wrong, again, we want to follow the money. It's going to things like the Infrastructure and Jobs Act and the CHIPS Act. We're seeing a manufacturing renaissance taking place in the United States, industrial production's booming in the U.S. Midwest. So we're looking to capitalize on that by investing in areas like mid-cap stocks, which have a large overweight to industrials companies that are directly involved in this manufacturing boom that's being helped by onshoring initiatives as well, with supply chains coming back from China and other parts of the world. So that's really the sweet spot. And guess what? You're not overpaying for it. U.S. mid-cap value stocks, they're on sale to the most significant level since the late 1990s versus their large cap counterparts.
When it comes to the deficit, and Lisa's point yesterday, this is really starting to gain momentum, but a lot of that is because 2025 is really going to be the climax of all of these issues. We're going to potentially hit our limit, and then of course they'll have these extraordinary measures to make sure we can still paying our debt until Congress gets its act together. And then of course there's the tax cuts. How are you looking at next year in terms of how much more the U.S. may add to the deficit?
Yeah, I mean, the way that we're looking at this as investors, because we're always trying to connect the dots between what's going on geopolitically and what it means for portfolios, is through the lens of bond yields. So you'll see it, right? You'll see it through higher bond yields if there's concern, if the market's pushing back on this idea that we're increasing the size of the deficit too much. But what we've seen over time is that demand for treasuries tends to outweigh supply. So if you see these bumps, if you see these moves higher in bond yields because of fears that we need to issue too much debt, eventually buyers are going to come in, especially if U.S. sovereign bond yields are so much higher than they are in other parts of the world. You look at places like China, their bonds are yielding 2.3%. Right now you can get twice as much here in the United States. So I think that demand for treasuries is alive and well, which should mitigate fears of a runaway deficit spending.
Emily, with all of that, what's your highest conviction trade right now?
Yeah, it's tough right now. It's still bonds. We love bonds. You look at the aggregate bond index, it's yielding 5.3%. That is really close to the recent highs of 5.7. The 20-year high is 5.9%, and the 20-year average is 3.25%. So the fact that you can generate a 5 to 6% yield owning high-quality bonds right now, get paid income, even if you've got to wait for the duration tailwind to kick in, I think this is a great opportunity to really back up the truck and get that income and lock it in for years.
Emily Rowland of John Hancock Investment Management. Enjoy the party. Thank you so much for taking the time. We really appreciate it. Right now, let's get you an update and stories elsewhere this morning. Here is your Bloomberg Brief. Danny Berger with us now. Danny.
Thanks, Lisa. Ceasefire talks between Israel and Hamas are at a standstill after the latest offensive on the outskirts of Rafah. Talks to pause fighting and secure the release of the hostages have been deadlocked for months. The two sides remain far apart on the status of Israeli troops in Gaza and for terms for the release of hostages held by Hamas. Now, the star witness in Donald Trump's criminal trial is set to return to the stand today after directly tying Trump to the hush money payments made to porn star Stormy Daniels. Former Trump fixer Michael Cohen elaborated on a trove of emails, texts, and conversations. His testimony is potentially the most damaging to the former president so far. Cohen gave a firsthand account of Trump allegedly giving directions to falsify records. And President Biden has announced sweeping tariffs on Chinese chips, minerals, and EVs. They affect about $18 billion of imports. Marvin Barth, founder of Thematic Markets, told me earlier that the tariffs go beyond just signaling to voters.
Of those trade sanctions, they're not symbolic. They are exactly part of an ongoing, undeclared, non-kinetic war between the U.S. and China. Yeah, you're not importing a lot of EVs now, but the point is you don't want to, and you're trying to protect industries that you feel are critical in times of national emergency, including warfare, by the way.
That was on Bloomberg Brief, which you can catch every morning at 5 a.m. ET. And that was your brief. Lisa.
Thank you so much, Danny. Up next, the consumer feeling the pinch.
Real wage growth has been recovering for much of the past year. It's starting to stagnate. Consumers are feeling the pinch from inflation. They're starting to lose purchasing power again, and they're feeling pretty sour about it.
That's coming up next. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
We could face bigger challenges next.
It was going to keep World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Earning Earnings season is here.
This is a get out the popcorn moment.
An across the board just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
And lots still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
The last gasp of earnings season as we head toward a key slate of inflation data coming out starting in less than 90 minutes time with PPI. We can see markets trying to inflect higher, not really doing much of anything. 52.47 up about, 4 basis points in the S&P futures, which you can see at a 10-year yield lower, down from 470 on April 25th. Just to give you some perspective, 447.47. Crude really just steadying as people take a look at the supply and demand dynamics and decide, I'll pass on this trade. Under surveillance this morning, the consumer feeling the pinch.
Consumer sentiment has been one of those where it's watch what they do, not what they say. We have seen wages moderate, yet inflation is staying sticky. So where real wage growth has been recovering for much of the past year, it's starting to stagnate. Consumers are feeling the pinch from inflation. They're starting to lose purchasing power again, and they're feeling pretty sour about it.
Here's the latest. Shares of Home Depot up slightly this morning, despite reporting a 6th straight quarter of negative sales. Investors also looking ahead to retail sales data tomorrow and Walmart earnings on Thursday. Joe Feldman of Telsey Advisory joining us now. I'm very pleased to say, Joe, thank you so much for being here. I want to start with Home Depot, this idea that the shares are gaining despite a miss pretty much across the board as they really point to some sort of continuation of their forecast. Just how weak was it under the hood in terms of these results?
Well, the sales were definitely a bit softer than expected. And when you look at the U.S., same-store sales were down 3%, which was a little worse than expected. The EPS was a little bit of a beat by 3 cents. However, if you adjust or normalize the tax rate for what we in the street were thinking it was going to be, 9 cents of the earnings came from that. So it was a little bit softer from a quality of earnings perspective. But I do think that expectations were kind of low heading into this print. And so maybe there's a little sigh of relief in the pre-market trading. The pre-market trading is also quite volatile, so it's always hard to get a good read on what it is. But our understanding is that the company feels pretty good about the health of their consumer. It's just that their consumer is not spending on home improvement right now. They're choosing to spend elsewhere because of inflation and other pressures in the market.
How much is Home Depot kind of a story unto itself because of the home improvement angle and how sort of divorced the housing market has been from a number of other consumer-facing industries?
Yeah, I think that's a great point, Lisa, because home improvement is its own kind of world. You know, by definition, the homeowner is a bit more affluent as a consumer, tend to be employed, have good wage growth and good jobs. And so as a result, they tend to be able to spend a bit more. There was a lot of projects that happened during the pandemic, a lot of big ticket spending. People redid bathrooms, kitchens, bedrooms, living rooms. And so a lot of that has really slowed. So there was that pull forward. This year is still a bit of normalization from that. So again, that's why I feel like that core consumer has the capacity to spend, but they are deferring some of the current big project spending. Weather also played a factor in the quarter for what it's worth.
Joe, we'd love to get your take on Walmart, which is coming out later in the week, to really understand also what's going on with the consumer, especially as Walmart, according to the Wall Street Journal last night, is laying off people in their corporate space. Does this show that they are struggling at the moment?
I think I don't think Walmart's struggling at the moment. I think Walmart's business has been pretty solid. I think we're going to hear good things about traffic to the stores, people continuing to go at an increasing rate. I think we're going to hear that the food and consumables business is strong. Discretionary has definitely been a bit softer. I think Walmart, they've become a much more efficient company and focused on expense control in a much greater way. And I think that they're finding ways to leverage technology. And in some cases, it could replace some people at the corporate office. That's possible. But they are becoming a more efficient operator, which I think from an investment standpoint, Wall Street does like.
But from an economic standpoint, this is the U.S.'s biggest employer, 1.6 million people. Is it concerning potentially cracks in the broader labor market?
Yeah, I think they're just being efficient. I think any good company is always working through and trying to find efficiencies where they can adjust their business model. Remember, they just closed down the health business, and that was a big number of people from the corporate center. And by what I mean is those standalone clinics. They still have, pharmacies in the store, and they do offer clinic in services within the Walmart stores, but they had about 40 or so of these healthcare clinics that they are closing. They found that as a business model, it just didn't make sense for them to operate. It wasn't going to be profitable enough over time. And so they decided to close. That's really where I think you're seeing some of that pressure on the corporate side.
When we take a step back, there's been a real question about what the conclusion is from this earnings season. Just from the retail lens, can you give us a sense of how consistent the read is that, yes, there is this softening of consumer demand and maybe pushback on some of the higher prices, but there is stability in spending? Is that basically the ongoing story pretty much across the board?
That is what we're hearing, Lisa. I think that, we've seen spending has slowed, broadly speaking. We've also saw weather had an impact on that during this first quarter, the colder start to spring in many parts of the country. And so I think that we're hearing that from a lot of the other retailers that are out there. And broadly speaking, the consumer has softened a little bit, which makes some sense given all the pressures that are out there. However, generally speaking, you're seeing total retail sales are still up a couple of percent. Some of that is inflation. I get that. But the consumer, when you look at credit metrics, you look at the savings rate, yeah, things are softening a bit, but they're still not terrible. I just think the consumer is being a little bit more cautious. Some of the pressure you're seeing is also related to services. I mean, insurance costs, healthcare costs, those are up significantly. We don't hear enough about that, I think, as it relates to the consumer. But, when your auto payment goes up quite a bit because of the insurance, plus the cost to lease a car or buy a car is up, that's a lot of pressure on the consumer.
Just quickly here, weather. Do you buy that? I mean, was it really that cold that really it drops 5 degrees and people say, forget it, I'm not going outside today? Are we that weak?
Well, I do think that there is a planting season, so there is some truth to it. I do think that some people tend to buy closer to need. We've seen that for the past several years now. You hear about it in winter. When it gets cold, that's when people go out to buy gloves and scarves. And same thing with spring. I do think that people wait till the weather is a little bit better. We've heard, like Tractor Supply talked about, as spring improved, their spring sales picked up quite a bit. I think we're going to hear the same from Home Depot this morning, where they talked about spring started soft, but where weather got more normal, they started to see the pickup in demand. So there is some truth to the weather effect on retail.
They have to see the whites of something warmer's eyes before they go out and buy shorts. Joe Feldman, of Telsey Advisory Group, thank you so much. You're not buying that, are you?
Well, also, where's spring? I feel like on the East Coast, at least, we've gone to winter to summer, and almost it changes every single day.
It changes every single day, and I wonder if what that means for later on. I'm sure we'll be complaining about a really steamy winter. You mentioned Walmart, and I thought this was interesting. It wasn't just cutting jobs. It was also saying that whole remote work thing, not so much.
And when I read that in the Wall Street Journal last night, I thought, who is still working from home? I know some companies still have a policy, you can be flexible, but didn't remote work end? I mean, especially for a place like Walmart, people are out and about shopping in your stores.
Yeah, it depends. I mean, this is the corporate offices. They've got tens of thousands of corporate workers as well.
But all your workers are back in the stores.
And there's sort of a question of what is the importance of getting everybody back versus sort of signaling to people who've been back for the whole of this time. Coming up, former National Economic Council Director Gary Cohn. He's going to be speaking about all things, both policy and investment, as he is currently at the cross-section of both. Right now in markets, not a lot of action as we assess what is going to happen with PPI ahead of tomorrow's CPI and retail sales, the 1-2 punch, to give you a sense of whether we can kind of write stagflation out of the books. For now, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
One hour to the beginning of a slew of blockbuster inflation data, beginning with PPI. Good morning. We are seeing markets doing nothing right now, basically going nowhere. They basically went nowhere yesterday, but they've come a long way going back since the third week of April. What we can see is a gain of about 5% in the S&P, a gain of about 7% in the NASDAQ. One share in particular seeing some particular gains, GameStop extending its rally up 118%. Welcome back, Roaring Kitty. People are very excited. Still, those shares down significantly, some 90% or so from some of the highs of all of the meme stock frenzies. We can talk more about whether that is the beginning of a new surge in it, or whether this is a frenzy, or whether this is just Roaring Kitty coming back and everybody celebrating. We'll talk extensively about that. We will not talk extensively about that. Right now in the bond space, you do see yields in just a touch, although again, some Noland in the market as we do wait for PPI, CPI, and retail sales coming tomorrow, 447.86 on the 10-year. And then currency space also really not doing much. We could see 107.97, a bit more euro strength, a question around whether this is a Fed prepared to cut rates regardless of what the inflation data shows. Under surveillance this morning, President Biden announcing new tariffs on China, targeting electric vehicle batteries and solar cells. In an interview with Anne-Marie before the announcement, Treasury Secretary Janet Yellen saying some form of retaliation from China is, quote, always a possibility.
The president believes that it's critically important for the United States to have a role and a presence in strategic industries like semiconductors and like clean energy that are going to be the foundation of good jobs and national security in the decades ahead. He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
The U.S. at the moment is spending just as much every year at this point on paying off our debt as it is funding our military. Does the U.S. need lower interest rates in order to balance the budget?
Well, we have to take the interest rate path that prevails in the economy as given. The president's budget incorporates the assumption that interest rates will be in line with the projections of private sector forecasters. So there has been an increase in the interest rate path that's assumed, and it's necessary to make sure that we're on a fiscally sustainable path. Of course, the higher interest rate path makes that more difficult, but the president's budget would hold the, I see the key metric that summarizes the burden of deficits as being its interest cost. And the president's plan would hold interest cost at historical levels and not allow them to rise above that.
That was Janet Yellen speaking to our own Anne-Marie Hordern, in part about what China's response would be. And we did get this morning, Anne-Marie, a response from China.
Yep, the Ministry of Commerce coming out and saying they vow to take measures to defend their rights. They say that they resolutely oppose what the U.S. is doing this morning with these tariffs. They say the decision is, quote, political manipulation, and also, Lisa, urging the U.S. to cancel the extra tariffs and correct this, quote, wrongdoing.
Let's see whether that works. Joining us for the rest of the hour is former National Economic Council Director Gary Cohn. Gary, so much to work through here in terms of whether it's tariffs, whether it's the fiscal policy, or whether it's the deficit. I want to start more broadly. This question of how much are from some of the fiscal policies directing investment theories right now in terms of where some of the money is going and what gates are being put up.
Well, look, fiscal policy and monetary policy are directly impacting how money is being spent, what money is available today. And I think that's even a more important topic. You know, we have gone through a pretty vicious cycle over the last 4 years where we went from a cycle of zero interest rates and abundance of capital available for almost all startups in this country, and funding at various stages of your progression from startup to early stage to mid stage to late stage to IPO, to a place where we are today, where there's very little investment capital available for young companies and startup companies, and the IPO market just starting to reopen. So that is all a function of fiscal policy, monetary policy, because they're inextricably linked. You know, when people were not getting a return on their capital in the bank, and there was a zero risk assets out there, you know, people bought assets they thought could provide an enhanced return for them. So they were willing to take more risk. They were willing to invest in startup companies. Today, you can go out and buy a 6-month treasury bill and get 5.3, 5.4% on a tax preferential asset. So we have changed the whole mentality of the way people think about holding capital, investing capital, recirculating capital. Also, with the capital markets having been closed for so long, a lot of that capital that was invested 3, 4, 5, 6, 7 years ago, many of those people thought it had a 3, 4, 5, 6 year duration. They would get liquefied by taking those companies public, and then they would recirculate that risk capital back into the financial markets. They have not been liquefied because the capital markets have been closed, so therefore that risk capital does not get to recirculate back. So a little bit of the natural cadence of capital moving in and out of risk assets has changed, both because of fiscal policy and monetary policy.
There's a lot to unpack right there. Are you basically saying that on the monetary policy side, low rates usually benefit the smaller, more leveraged companies? Rates go up, that benefits more some of the larger companies that are able to be sort of term out their debt structures in a more considerable way. Are you saying that fiscal policy also benefits the bigger companies more because they're the ones that are eligible for some of these grants?
I didn't really say what you're saying. I don't think higher rates help anyone.
Okay.
Like if you're a large company and you're still running a large debt portfolio, you're always worried about your weighted average cost of debt, your WACD. So you're thinking about what that is, and the lower it is, the better it is. You know, ultimately at the end of the day, you know, you sell your goods or you sell your services to your customers. Then you've got your expense line, which is usually the biggest line in the expenses is salaries and costs. But then if you get down a little bit down, cost of debt is a big item. So to the extent that cost of debt goes up, the price of your goods or service has to go up. So companies, you know, either the profit margins contract as interest rates go up, or they have to raise the price of their goods. So in a perfect world, no one really wants interest rates to go up, but there is a sort of middle ground where interest rates are at a level low enough where they're not really affecting, and the economy is growing without fiscal stimulus from the federal government. The question is really more when fiscal stimulus from the government comes in, how does that react? And right now, we actually have one of the most unique periods of time because we've got, on one hand, we've got the Federal Reserve, which is trying to raise rates to slow down economic growth, to get inflation under control. And we've got the federal government on fiscal policy on the other side, looking to invest capital to grow the economy. Those two things are countervailing forces. You know, we don't see a lot of times in our economic history when we've got both of those things going on at the same time. Usually we're in unison. Usually the Fed's trying to grow the economy by lowering rates, and the government is trying to spend money to grow the economy. That's normally what you see as you're coming out of a very tough economic period. When you're in a very robust economic period, the Federal Reserve is raising interest rates, trying to slow it down, and the federal government does not need to spend money because you're in a very robust economic time. This time, it's very different than the historical past.
As an investor, who do you bet on winning, the Fed or fiscal policy?
You know, I don't know if there's a winner or a loser. I think you have to be realistic to what's going on and who's trying to do what. The Biden administration has been pretty consistent on their fiscal policy agenda. They have been trying to spend money and put money into the economy since day one. Since the first COVID relief, $1.9 trillion they put in early. And they continuously find ways to put money into the economy as recently as relief of student loans. So they're continuously looking at ways to fiscally stimulate the economy. The Fed, on the other hand, is responding to the outcome of that money being put in the economy. There's a cause and effect. You know, many of us think the effect is so much money being put in the economy, the money supply expanding so quickly that you've got too much money chasing too few goods, and therefore you had an inflationary time and inflationary pressures. And so the Fed is responding to the effect of the cause, and they are raising rates trying to slow that down. So if I were going to bet, the Biden administration will continue with fiscal stimulus. In fact, they have a lot of stimulus already approved where they have not given out the money, so that money has not fed through the economy, and the Fed will continue to monitor the financial conditions, and most importantly, they'll continue to monitor the path of inflation based on the data that they get, and they will decide what rate policy looks like based on that.
Gary, I want to ask you about the next fiscal fight, which is the Trump-era tax cuts. They are coming, they're expiring next year. Do you think they should be extended?
So, look, I think tariffs is one of the most interesting topics that we dealt with when I was in the White House, and I think the Biden administration is dealing with now. You know, it's interesting, despite a lot of rhetoric, the policies are starting to bend toward each other. It's hard to know the difference between the two, let's call them candidates' policies today.
Do you agree with tariffs? Because they're inflationary.
I'll talk about tariffs. So when you look at tariffs and you think about tariffs on things that we manufacture in the United States and we can sustain ourselves, I think it makes sense to tariff a country that is importing things in the United States at a below cost. So we know that China has some real economic advantages. We know that they don't pay fair market labor. We know that they don't have a cost of capital. We know that they don't have environmental restrictions that U.S. companies have. So we know they've got a competitive advantage. So if they're using that competitive advantage to dump products in the United States that we make, and therefore they're displacing U.S. manufacturers and U.S. jobs, yes, we should protect our border. On the flip side, if they are exporting and we are importing goods that we need, that we do not make in the United States, and there's no replacement for us in the United States, and we put a tariff on it, it basically becomes a consumption tax. You and I and all of us are going to buy those products. We're now just paying more for the same product.
Do you think that we're going to see more of these walls go up, whether or not Biden or Trump get in the White House next year? Like, how high are we talking?
You know, I think there's a thought right now that the wall should go higher. I think at some point there is diminishing returns. You know, we've got a lot of historical data on putting tariffs in, whether there were old steel tariffs under other presidents. When I was in the White House, we did a 301 on washing machines. And if you look at the whole theory of what happened with washing machines, it's quite interesting. You know, we put tariffs on washing machines, but the prices of dryers went up equally with washing machines because, you know, the manufacturers think, well, people think washers and dryers cost the same thing, even though one had tariffs on it and one didn't. You know, very inflationary to buy a washing machine and a dryer. You know, did it bring manufacturing back to the United States? Yes, it did. We brought the foreign manufacturers, you know, the LGs and the Samsungs that were importing in the United States. Did they open manufacturing in the United States? Yes, they did. So we did create some jobs, but we really increased the price of the washing machine and the dryer. So there's a lot of historical data on what happens when you tariff things.
Gary Cohn, you're going to be sticking with us. We've got a lot to talk about. Up next, clinging to U.S. exceptionalism.
And I feel we kind of clung to this American exceptionalism too long. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now.
That's coming up next. You're watching Bloomberg Surveillance.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a quiet day at a time when a lot of people are looking to PPI data coming in about 45 minutes, heading into tomorrow's CPI, as well as retail sales. We do hear from Jay Powell today as well, which should be interesting given how many people are banking on the Powell pivot. Let's get straight to it. Under surveillance this morning, clinging to U.S. exceptionalism.
And I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months ago, yet all you heard was American exceptionalism, American exceptionalism, American exceptionalism. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now.
Here's the latest. Treasury yields holding steady ahead of U.S. PPI data. In comments from Fed Chair Jay Powell, Ed Al-Husseini of the Columbia Threadneedle writing this: the shocks that now largely played through the system. However, the distribution of inflation has not fully shifted back to a level centered around 2%. Ed joining us now. Ed, want to get your view on whether people are too optimistic optimistic about the disinflation trends and maybe this pivot that the Fed seems like they're not totally or all on the same page with?
Yeah, I mean, look, largely it's a matter of timing. And what we're realizing now, especially looking at the data over the course of the past 6 months, is you can get a lot of short-term shocks in month-to-month data. In Q4, inflation decelerated perhaps a little bit faster than the underlying trend. In Q1, we saw data move up a little bit faster than the underlying trend as well. If you average it out, inflation's still trending somewhere between 2.5% and 3%. And the question is, how much time will it take for us to squeeze back that 50 to 100 basis points in the course of the rest of this year?
Right now, actually, this morning, we haven't mentioned this yet, but we did get the Small Business Optimism Index, and it actually increased for the first time this year, in large part because small businesses saw the potential for prices to go down. Many fewer people expect them to keep going up. Is this the kind of data you follow at this point more closely than even PPI or CPI, given some of the lag effects that a lot of people are pointing at?
Yeah, I have to be honest, soft data has given us a lot of false signals in the course of the past 2 years. I mean, you start with PMI data, a lot of the survey-based data has had the economy in a relatively weak position. That's at sharp odds with consumer spend, it's at sharp odds with CapEx, and it's at sharp odds with just the broader inflation story. So yes, there's a place for soft data, like the NFIB survey and so on, but largely it's been a false signal.
Meanwhile, we have Gary Cohn here, former National Economic Council director, as well as the part of the board at what we're looking at more broadly. I'm wondering, from your point of view, how much are you seeing in the companies that you oversee and you invest in this ongoing disinflation?
I don't think we're seeing a lot of disinflation at this point. You know, in the enterprise world, in the corporate world, there's not a lot of disinflation. In fact, most companies right now are trying to figure out how to run themselves much more efficiently because there are a lot of price constraints in the system, and there's becoming less and less ability to push price down into the customers. The customers are becoming much more discerning. So I think what you're seeing in big and small companies today is they're trying to figure out how to run themselves more efficiently. You know, the AI trend is clearly something that everyone's looking at. How can that help me in the efficient frontier? How can I be more efficient with my people? How can I be more efficient with my technology? And we're seeing that in big and small companies today.
When you look at potentially like Bank of America coming out and saying they're warning that the stock rally is exposed to stagflation risk, do you see potential stagflation in this economy? You
know, I'll quote the chair. The chair. I don't see the stag and I don't see the inflation. We're still growing. We're still growing at 1.5%, 2%, and the inflation is pretty steady. Look, I think it is. I think we agree that it's going to be harder to get inflation down. The last mile is very difficult. There are a bunch of issues in inflation that higher interest rates won't cure. You know, we've got a commodity bull market going on right now. We've got uranium prices and copper prices and anything having to do with the electric power grid going up pretty substantially. You can raise interest rates as high as you want. The demand for electricity between EVs and between GPUs and CPUs, it's not going away. So we've got some fundamental shifts going on that are going to take some time to just work through the system.
Jeff Curry with his copper bracelet kind of banking on that. Ed, from your vantage point then, how much are people over their skis with respect to betting that the Fed is going to cut rates this year, potentially twice, especially as Fed Vice Chair Philip Jefferson yesterday said he favors holding rates higher for longer because, frankly, we're not seeing that disinflation.
Yeah, and the question is, where do you look for that disinflation? I think one of the key stories for me has been the slowdown in wage growth. In fact, I've been surprised by how quickly wage growth has slowed, given the underlying dynamism and the strength in the labor market. If that pattern continues, again, it builds the foundation for the Fed to have confidence that, one, inflation expectations are still in the right place, and two, that center of gravity, the combination of inflation expectations and wages, will pull that inflation down. So yeah, 1 or 2 cuts seems pretty reasonable to me right now.
Do you think they come before the election?
It's tough. I mean, look, we're struggling to get our hands around the inflation story. That's going to come first. That's going to be the primary source of the timing here. Do they have room before the November meeting to move? At most one at this point. The calendar is definitely working against them. You have to build confidence in the data.
Gary, you laughed. You think it's going to be an issue?
No. I think I'm in the 2 camp as well, and I think one will definitely come before the election. But as the Fed chair, you're sort of in this precarious position. that if you do it too close to the election, people are going to talk you're being political. But the Fed calendar is set years in advance, and so there's only, like, in this environment, there's only certain dates you can do it. I'm old enough to remember when the Fed had emergency meetings and cut and raised interest rates whenever they wanted to.
Yeah.
I don't think we live in that environment anymore.
Let's rip up the script a little bit. If you were National Economic Council right now, and I know it's the other side to President Biden, what would you be doing differently with messaging? Because they're not getting the message across about disinflation, and frankly, inflation is one of the #1 issues.
Look, I do think they have to figure out a different tactic on messaging. I mean, we see it in the data. We see that the data tells them very clearly that, you know, the top 1 or 2 issues that voters will vote on is the economy. And when they talk about, when voters in America talk about the economy, it's a very simple equation. Does what I bring home at the end of the week or the month or whatever my pay period is, does it buy me more or does it buy me less than I thought it'd buy me when you came into office? So therefore, is my disposable income going up or is my disposable income going down? The Biden administration has to figure out a way to convey that you are better off today than you were 4 years ago. And if they can't figure out a way to convey that, they will lose on this messaging. And the Republican side has done some very interesting marketing on putting out the basket of groceries and showing what the basket of groceries cost, you know, 3.5 years ago and what it costs today. The Biden administration has to go out and say, look, this is what you were paying for. This is what you were getting 3.5 years ago. This is what you're getting today. Here's what I have done for you, and here's how I have done it. They've got to actually put a sort of a point on the issue instead of talking theoretically.
Well, they're trying other things. Like this week, they're calling it Infrastructure Week, real Infrastructure Week.
Really?
You see all
I
the money.
never heard that one before.
Well, why is that not landing? I was with Yellen talking about, she was talking about, you know, broadband in rural areas. Why does this land?
Well, I don't know why it doesn't land, but at the end of the day, you know, I heard her talking about bringing broadband. They were in Virginia or West Virginia yesterday, bringing broadband to 700 families. You know, you can take Starlink and bring broadband to 700 families in a minute. You can give them a Starlink password. You know, they brought Starlink to Ukraine literally overnight. And so, like, these are things that are interesting and they're good and they're important, and everyone should have the internet. No one should argue about that. But these are not major events. And for those 700 people that got internet, it's really important. It doesn't move the needle in the country. You've got to talk in a bigger swath of people when you're trying to move the emotion of the country.
Well, people have their shovels ready. We were talking about that. Ed Al-Hassani, too short. I apologize. Columbia Threadneedle, former National Economic Council Director Gary Cohn, thank you so much. As we do look forward to the PPI data coming up, Chris Marangi of Gabelli Funds, Bank of America's Elias Galou, Lara Rame of FS Investments, and Bloomberg's Gina Martin Adams. We are watching Bloomberg surveillance on PPI Day.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology?
I had actually run tech banking and took Google Public, so I had a little sneak preview.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Economic surprises have really plunged over the last couple of weeks and are now in negative territory.
The momentum in inflation in the last 3-4 months has just been moving in the wrong direction.
The tighter policy is, faster should be the fall in inflation. So what the Fed is doing is undershooting here.
We don't see any data to indicate that they're suddenly going to have to cut by 4 or 5 times by the end of the year.
We're going to wake up one day and realize, whoa, things aren't as good as we thought they were.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
This is it, the moment you've been waiting for. 30 minutes until PPI, kicking off that inflation data. Have we reached the pivot point that so many people have been looking for? From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. You'll get your good morning tomorrow. John Farrell will be back. Anne-Marie Hordern here with myself, Lisa Abramowitz, together with Laura Rame of FS Investments. I will get my words out for this hour. I am very pleased to say, as we take a look at whether we can get to that place of maybe more concrete disinflation. So far, Anne-Marie, we've gotten a host of Fed speak. It's been all over the place with respect to either leaning into this pivot or leaning out.
Well, this is what Philip Jefferson said yesterday, that actually if you have a whole host of Fed voices coming at you from different angles, it's hard to decide where the Fed is looking. But when it comes to PPI today, CPI tomorrow, and then, of course, the PCE that we'll finally get, you have to also look at other data. I go back to yesterday's Federal Reserve Bank of New York report. Americans last month braced for generally higher inflation pressures over the next few years. That is not something you want to see if you're sitting at the Federal Reserve.
Which is a reason why there's a real question about whether the market has too much confidence about the disinflation narrative. And the Fed pivot that we heard from Emily Rowland is still very much a go. Laura Rame, welcome. Thank you so much for being with us today.
Yeah.
I know you're in the higher for longer camp, and you think people are underestimating the inflationary pressure. What have you seen recently, whether it's in earnings or whether it's elsewhere, that gives you that conviction?
It's been the whole picture. It's been wages as well. It's been the fact that unit labor costs are up. It's been the fact that we also had the University of Michigan numbers last week. You know, I love the Bloomberg Economic Surprise Index. You can sort of pull out pieces of it, and the inflation piece has been shooting higher because it's not just that inflation's been stubborn. It's been so much more stubborn than everyone has expected. And I think the markets still have this filter where they want to ignore the bad news on inflation and they want to get so excited and embrace good news. We may very well have a well-behaved, let's call it, PPI number today and a CPI number tomorrow that gives us a 0.2 increase. But I think underneath this is still that whack-a-mole sensation where inflation's kind of coming at us from unexpected places, and maybe it's not all together, but it's kind of popping up when we least expect it.
The expectation for what we get in about a half-hour time is 0.3% final demand month-over-month PPI, up from 0.2% in the prior month. Tomorrow with CPI, the expectation is 0.4% increase from just sort of staying constant. We shall see. Right now in markets, things steady. Not exactly a lot of drama going on as people parse through all of the earnings as we come to a close of the earnings season or get to the tail end of it. And as we look toward that PPI data, basically not going anywhere for S&P futures. Unchanged. We could see yields just marginally lower. Not a lot of action, although you are seeing in GameStop up more than 117% as people take a look at what's going on with the meme stock frenzy. You can make of that what you will. Coming up, we're going to be speaking with Chris Marangi of Gabelli Funds with stocks stuck in a tight trading range ahead of U.S. PPI data. Bank of America's Elias Galou on the latest fund manager survey, and Bloomberg's Gina Martin-Adams on the resurgence, as we just mentioned, of meme stocks. Right now, stocks stuck in a tight range ahead of U.S. PPI data due out just about 30 minutes from now. Chris Marangi, meanwhile, we're talking to Laura Rame here at a time where there is this question about what you're going to be looking for. Right now, what is your base case? How people will react one way or another, upside or downside surprise?
I think if we get an upside surprise in inflation, simply because the trade is so crowded that we're going to sort of finally see this disinflationary path resume, I think we are going to get a jump higher in interest rates. When I look at the overall interest rate picture, to me, it's very much one of renormalization to where we were back, even before the financial crisis into the mid-90s. I think we're going to be, as you say, in this higher for longer place. But I also, when I see the range of possible data outcomes, people have no consensus around what the Fed's going to do. I see right now every data point is a possible flashpoint for volatility, and I think we're going to continue to see that today.
Chris Marangi of Gabelli Funds seeing more signs of the economy slowing and taking a defensive approach to the market, recommending the less cyclical industrials, live entertainment stocks, staples, and utilities. Chris joins us now. All of those things are not the same in terms of defensive, and I want to start there. Live entertainment, defensive?
Well, it's actually one area where there's the secular tailwinds have outweighed any kind of cyclical headwinds. Lara's obviously been talking about inflation, and Gary Cohen said he hasn't seen inflation or stagflation, but you can't lose sight of the stag part. Economic growth is slowing, it would seem, in most areas, but the consumer is still spending on live experiences, going to concerts, going to sports events, et cetera. And there's limited ways to play that in the market, but we're taking advantage of them.
Basically, you can bet on Taylor Swift even in a slowing economy. Chris, at this point, how have you shifted some of your allocations? I know you like to focus on specific companies that you like. Is there something that has made you shift in the earnings, in some of the softening that you're seeing in the discretionary spending?
Not really. We're always looking for companies with pricing power. We're looking for companies that with good managements that can adjust for different financial conditions. Obviously, financial flexibility on their balance sheets. But we are being a little bit more defensive, as we noted. I don't think we're late cycle. We are late cycle here. I don't think we're ready for a new economic environment. We're obviously waiting for the Fed like everybody else. But focus on the same good companies that we've owned for decades.
Lisa mentioned this at the top of the show, but now I see Tupperware is up more than 10% this morning. So I have to ask: are meme stocks back?
It would seem that way, just when you thought they were gone. And this is not inconsequential. This is not the kind of behavior that you see when financial conditions are tight. So the Fed, I'm sure, is watching this and seeing what happens. Those of us who manage small cap funds remember 2021 quite well. There were 3 stocks: AMC, Bed Bath & Beyond, and GameStop, which added about 300 basis points to the Russell 2000 Value Index. It was about 10% of returns that year. Nobody owned them. No institutional managers owned them. And then they came out and they crashed after they were removed from the index. So, you've got companies like AMC taking advantage of the situation, raising capital at what appear to be very cheap rates. And we'll see what they do with it. But this probably has some legs.
Chris, when you look at the small cap universe, it has been underperforming the large cap space. I know there's a lot of dispersion within the small cap space. What do you view as a broader mega trend within small caps? It does seem like, aside from a couple of standout positives, the quality underlying the Russell 2000 is deteriorated.
Yeah, obviously the Russell 2000 value, which we're focused on in particular, is over 20% financials, and there's some real questions about the quality of those earnings and those companies, particularly the balance sheet with the asset side, with the commercial real estate exposure. The companies tend to be more cyclical, have less pricing power, more levered balance sheets in general, but we are finding good companies within that, and that's the opportunity to beat the index.
And when you, I think, look at this broad opportunity, do you see a difference between the way that small caps are insulated from geopolitics, or do you feel like they're really more beholden to the broader cycle?
Yeah, certainly they are often viewed as safe havens, obviously with a domestic focus, and that's an attribute in times like this. But they are, in many cases, very cyclically sensitive, and it's the one thing that sort of keeps us from being all in on small cap, given some of the concerns we have about the economy. But the valuation gap is quite wide, and you're really getting paid to take those risks today.
Meanwhile, people are all looking to what's going to happen in about 21 minutes' time when we get the first read of a pair of inflation readings. What are you looking for? How will you respond to either an upside or a downside beat?
Probably not responding at all, to be honest. I mean, listen, this is another data point in the continuing narrative. Do think that the Fed will cut later this year, but the path to normalize rates and normalized inflation is going to be longer than the market perceives.
All right, so if you're not going to really respond one way or another, how have you basically adjusted your viewpoint going out based on earnings as they do come to a close, really capped off next week by NVIDIA?
Yeah, again, I think probably a bit more defensive, a little bit more cautious than I was the last time I was on 3 or 4 months ago. We are definitely seeing some signs of slowing, and I think one thing to keep in mind is 3% is sort of the new flat. As you look at top lines, if companies aren't growing the top line at that kind of rate, they're probably losing ground. They're either not pricing up or they're losing some volume. So we are in a different world, obviously, than we were just a year ago.
Chris Marangi of Gabelli Funds, thank you so much for being with us. Laura, that is something that we've been hearing, that there has been clear slowing down. Why is that not enough to really offset the inflationary pressures that you see as being sticky in the system?
I think it's several reasons. One, we just cannot underestimate this wage component. I think that is something that is, here with us for some time. The labor market remains incredibly tight. I think it's also the housing piece. And, hopefully it's something we can dig into a little bit later, but these rent prices have just not come down as much as people expect. And if we do get some relief, I expect it to be short-lived, because in Q4, I think we're going to be right back into an apartment shortage again. So it's a confluence of things. And boy, those two pieces are huge when you think about the household monthly budget.
That rent is just too damn high. Is that what the potential calendar is? We also are going to be talking about tariffs and what's going to be happening with that. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Chevron's bid to buy Hess has hit a snag. Investors are being urged to abstain from voting for the deal. A shareholder advisor cited concerns about its valuation and a dispute involving Exxon over an oil project in Guyana. It's yet another blow to what would be Chevron's biggest deal in 2 decades. Now, moving on to Kraft Heinz, it's looking to sell Oscar Mayer, the maker of lunchtime fixtures like hot dogs and cold cuts. The Wall Street Journal first reported that Kraft Heinz reached out to Bank of America and Centerview Partners to gauge interest in the brand. Sources said that Oscar Mayer could fetch something in the neighborhood of $3 to $5 billion. Kraft is in the middle of a multi-year effort to improve the nutrition of its products. Now, Swiss shoemaker On has posted strong first quarter revenue. It boosted its sales forecast on strong demand for its running shoe and a new line of apparel. The Roger Federer-backed brand has expanded rapidly across Europe and North America. On is now looking to broaden its reach into tennis and training, trying to take market share from more established rivals like Adidas and Nikes. And that's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, rate cut bets driving bullish sentiment.
I think they'll take out some insurance cuts, which will elongate the recovery that we're in. and that will ultimately set up this bull market to last for years to come.
Expect more discussion on insurance cuts, on cosmetic cuts, on other cuts, welcome cuts. It isn't easing. That's what they want to say. That's next. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg Surveillance on PPI Day, heading into CPI Day, heading into whatever other acronym that you're going to look at that will maybe give you a sense of whether we're disinflating on track. Right now, markets doing nothing, although inching just a little bit higher, 52.48 on the S&P. Yields inflecting lower, and really it's the round trip that we've seen, both rising to the highest that we've seen going back more than a decade now. 447.86 on the 10-year. It was 470 as recently as April 25th. Under surveillance this morning, rate cut bets driving a lot of the bullish sentiment you see out there.
I do think that the Fed is going to cut rates before the end of this year. I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
Which is a reason why there's been some confusion, particularly among investors surveyed. Here's the latest. Fund managers are the most optimistic about the state of the market since November 2021. That is according to the most recent Bank of America Fund Manager Survey. It also shows cash allocation at a 3-year low and stock allocation at the highest since January of 2022. Elias Galou of Bank of America Securities joining us now. Elias, how do you explain this, especially given the fact that in the survey, people are ratcheting down their expectations for earnings and growth?
Hi, it's a pleasure to be here again. So yes, this was pretty much the most bullish survey of the past 2.5 years. We had already seen in recent months a rising optimism regarding FMS investors, but the one notable development in the May Global Fund Manager Survey is that the remaining bullishness is no more driven by improvement in global growth expectation, but by a big conviction that global monetary policy will be easier in the next 12 months. We recorded big convictions that the Fed will cut rates in the next 12 months, and that both short and long-term interest rates will be lower by this time next year.
Elias, I know your colleague Michael Hartner was talking about the risks that this poses in terms of vulnerabilities. Should there be a downturn in terms of economic activity as expected, but stickiness in inflation? How pivotal are some of the prints that we're going to see, including PPI coming up, to really indicate whether people are going to get wrong-sided on this one?
Look, the next reports on CPI and retail sales tomorrow will be very important because when you look at this month Global Fund Manager survey, investors, yes, are slightly less optimistic on the macro, but overall, when you look at over the past 3 years, they remain quite optimistic. When we look at recession expectations, about 2/3 expect that there will not be any global recession, and specifically to the US, about 2/3 as well expect that the US will not experience any recession in the next 12 months. And investors are still convinced that the dominant macro scenario in the next 12 months will be a soft landing. It also seems that no lending odds have peaked, hard lending odds have troughed, but as you said, the biggest tail risk is inflation, and the biggest surprise would be an outcome of both higher CPI and slower economic growth, why tomorrow's CPI report will be very important.
Which would then mean the likelihood of the Fed cutting, that starts to become less of a possibility. What happens if the Fed does not cut? Given, if you look at this survey, the majority expect that this is going to happen at some point this year or beginning of next.
So it's the big conviction of this survey. 96% of FMS investors think that the Fed will cut. When asked about the timing of the first Fed cut, 82% expect the first Fed cut to happen in the second half of this year. And when asked about the magnitude of rate cuts, over 3/4 expect that the Fed will cut at least 2 or more in the next 12 months. So solid conviction that monetary policy will be easier. But if inflation spikes higher, that's the big risk. And if it does so, the Fed will be less likely to cut. And you see the inherent risk between no Fed cut, that is not expected at all, and higher odds of economic hard landing, which is now the number 3 biggest tail risk in this month's survey.
Elias, I think this speaks to one of the core questions dominating markets today. Can we continue to see a bull market run with higher interest rates? And I think if you and I were sitting here in January, back when we were expecting 7 rate cuts, that was what was priced into the market. And I told you, by May, we'll only be pricing in 1.5. And markets are going to be fine. I think we would have really had trouble believing that. And yet here we sit today. So even though I recognize the conviction in the rate cuts in your survey, I think if we don't get any rate cuts this year, the markets could still continue at least to be stable where they are. Let's face it, we're at very high valuations today. It doesn't seem like rates have really caused that much of an issue for markets or for market sentiment, as long as the growth is there.
And that's the key point, as long as the growth is there. As you said, rate cuts expectation have come a long way from the lows in January, but the main element is that growth has held up in the first 4 months of this year, and that is why we were recording in the different surveys in the recent month improving growth expectation. This time, macro sentiment has ebbed, but the conviction regarding easier monetary policy still stands at very, very high level. So the one macro development to watch now is inflation, of course, but can growth remains at resilient levels? And yes, if growth slows and inflation stays sticky at high level, that would be the most contrarian outcome for investors.
Well, and I think when you think about growth slowing, this is also where you need to start to really get granular about numbers, because if we're growing around 3% right now, Q2 GDP estimates, early estimates, are as high as 4%. When you talk about slowing, are you talking about slowing to 2.5%, to 2%? It sounds like we're nitpicking about numbers, but this is the kind of magnitude that matters when you're at today's really stratospheric valuations.
Sure. I mean, the magnitude in terms of a slowdown is, can the global macro remain on a path towards a soft landing? if investors still believe that soft landing will remain the dominant scenario, and that is the case this month, with 56% of FMS investors say soft landing is the main scenario for the global economy in the next 12 months, then I think it's going to be a rather smooth path for risk assets. But you're absolutely right. The one investment conclusion from this month's survey is that positioning is no more the tailwind it was in 2023, and risk assets are definitely more vulnerable to evidence of higher inflation and a slowdown in economic growth.
Basically, Elias, if we could reframe this based on the trajectory of the fund manager survey over the past 6 to 12 months, how much do we see a pivot party priced in, a pivot party slightly priced out, and now fully priced once again?
Look, I mean, investors believe the Fed, and they are also data dependent. And for now, they are still holding to the view that a soft landing will happen, that no recession will be happening in the next 12 months. So soft landing, no recession, macro sentiment that remains near the highs observed in the past 3 years, and a conviction that large cap growth stocks will be the leader in terms of the bull market, and that is why investors' positioning is the most bullish of the past 3 years.
Elias Glue of Bank of America. Have fun hanging out with Brian Moynihan over in Paris as everyone, all of the executives in the finance world, descend on the region. Coming up next, we have breaking U.S. PPI data. But Laura, I wanted to follow up on something you were mentioning, this idea that we've been able to handle pricing out rate cuts substantially and valuations have hung in there. Do you agree with the point that Elia was making, which is there seems to be a vulnerability, a greater vulnerability now based on what people are pricing and based on their positioning, say, than a month ago?
I do. And I mean, by the way, how nervous? Am I the only one that's nervous? Like, I feel like a year and a half ago when everybody was calling for a recession, we didn't get one, and now everybody's bullish and the conviction in a soft landing is at all-time highs. I think that should be, a warning sign that we need to just continue to monitor diversifications and not put all our eggs in one basket.
Also a great point. What did we learn from the recalibration of 7 cuts to 2, maybe 1?
Yeah, we learned, I think, that we need the growth to handle the higher interest rates. I think that is, to me, where we go from here. I know that obviously the focus and the Fed, it's really about inflation, but when I think about market performance, growth is necessary for us to accommodate these higher rates. And I think we're stuck with the higher rates, where the growth now, to me, is going to be what market performance hinges on.
I would also argue that when people are pricing in 7 rate cuts, they're pricing in the chance of a hard landing.
Yes.
And currently, it seems like people are pricing that out. So if that gets priced in a little bit more, that's when it's going to be a little bit more difficult to swallow. Coming up, we get that PPI data. The expectation is for a 0.3% month-over-month gain, up from 0.2%. How the markets respond, kind of key. If we get an upside surprise, how big of a problem and a disruption is that going to be? A downside surprise, how much of a rally will that unleash? This is Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Here's the state of play 25 seconds away from PPI data, which is in some ways the appetizer for tomorrow's CPI data. Markets basically stagnant as we wait to understand whether we can really get on this soft landing bandwagon. Although S&P has been up about 5% since the end of the third week of April. You can see the NASDAQ futures doing nothing also, but up. Those have been up about 7% since that same time. Right now, we are getting that data. Michael McKee here with us to break it all down. Mike.
Bit of a fattening appetizer for you. We've got a 0.5% rise in PPI for final demand, the headline number. That compares with 0.2 the prior month. And for the core, also 0.5% rise. And the core X trade as well, up 0.4%. All these significantly higher than and had been forecast and significantly higher than last month. On a year-over-year basis, the final demand goes up to 2.2% from 2.1%. That is as expected. 2.4% for core. That's the same as last month. The forecast was for it to fall to 2.3%, and the core X trade is at 3.1 from 2.8. Now, here's an interesting revision. Headline PPI revised down last month to a negative 0.1% print from 0.2%, and the headline core also revised down from 0.2 to a negative 0.1%. So what that leaves us with is index values that aren't as high as the monthly change would imply, but they are still significantly higher than anticipated. So we do have some inflation in the producer price area, and I am guessing, Lisa, that we have some reaction in the markets.
We do, however, it fades. Mike, stay close as you parse through all of the details in a very detailed report, which we will get into in just a second. You can see that initial pop in yields, that sell-off in price, fade just a touch as people realize what Mike was talking about, which is that the revisions in the prior month leave this a little less of a surprise to the upside as many people had expected. In the yield space, you're not seeing as big of a reaction, just about 3 basis point increase in the 10-year yield. More market than the 2-year yield seems to not really move things. In the equity space, though, you did see a bigger downside surprise in terms of how markets were responding, down about 1/3% on S&P futures, down almost 0.5% on the NASDAQ. Russell futures not really doing that much. The question here is something of an inflationary pop that is more than expected worse news right now for equities than for bonds? Mike, you've had a second to go through it. What's the latest in terms of some of the details that you think we should pay attention to?
Well, headline pushed up a lot by heating oil and by natural gas. Both were up about 5%. That's a significant rise during the month, especially in a month when you're thinking you may not need the heating oil anymore. But I think what will catch most people's eye who are nerdy enough to look at this is portfolio management. This is what I have always called the POGO part of the PPI and CPI. We've met the enemy and he is us. When the markets go up, the market managers get more money, and that is what happened. Portfolio management up 3.9% during the month after just a 0.5% gain the month before. In March, we saw the markets go down, 0.5% gain. Now it's a 3.9% gain, with the rise in equities especially having an impact on this. This goes into the PCE, as does healthcare services. So those are things that are going to, you're going to see over the next few days, maybe people revising up some of their PCE estimates.
Just to recap, if you are just joining, we did get a strong upside surprise in the headline number for PPI final demand, coming in at 0.5% versus the expectation of 0.3%. At the same time, a revision lower in the prior month to a negative 0.1 print from the initially reported 0.2%. So you put it together, and it is still an upside surprise, but not as big as it might seem on first blush. The market response is a sell-off in stocks, in bonds, which you could see is yields shifting higher, although we're tracing some of the initial move as people parse through some of the details. And when you push it through the foreign currency market, where you could see foreign exchange market, you could see a bit of a stronger dollar versus the euro on the margins as people price out what this means for a Federal Reserve looking for some sort of disinflationary trend. We are getting some more revisions now for final demand year over year, also being revised lower for the prior month. So coming in at 2.2% for final demand this past month in April, with the sort of in line with expectations. So again, not as much of an upside surprise as people had expected. Laura Raim with us here of FS Investments, and I'd love to get your take on just how much this sort of edifies your viewpoint that it is sticky, it is higher for longer, and an important thing to watch heading into tomorrow's CPI.
Yeah, disinflation has stalled. I think that's the trend that I continue to see. And when you look ahead, you know, we've had a lot of tough talk out of the administration about tariffs. You know, the little relief that we're getting on the inflation front is more coming from goods. And that looks unlikely, that sort of global trend of lower goods prices seems unlikely to stay with us as, you know, sort of all of the low-level news that leads us to create our top-line CPI forecast is just continuing to push higher. This is another piece of it. I think we see pressure in commodity prices, for example, services prices. So when you look at it all up, I think today's number, you know, sort of, you know, monthly index data gyrations notwithstanding, the disinflationary trend is stalled out, and that's what I focus on.
Does this spell bad news for tomorrow's CPI?
I think that's what markets will probably push into their expectations. I do think that they are really, there's a lot of hope. Hope is not a strategy, but I think there is a lot of hope that after several months of upside surprises, we're going to see a more moderate CPI number tomorrow. But when I look at the, you know, the headline consensus expectation, 0.4%, that is a number that is inconsistent with the Fed's 2% target. We're just still running too hot for the Fed to comfortably cut rates significantly with the economic data as strong as it is.
Mike, as you look through the PPI, what are you picking out that potentially will spell bad news for PCE?
Well, the healthcare and the portfolio management are two things that will. We also keep an eye on airfares. They're calculated differently between the CPI and PPI, and so you got to kind of split the difference, and that'll go into what the PCE does. The PPI does not do residential housing, and that's going to be the big question tomorrow. PPI does construction, businesses construction, office construction, but the CPI and the PCE measure housing and slightly differently, and the question is, do we see a big change in housing? That will be probably the big mover tomorrow, besides some energy prices in the CPI.
I think the question, you know, and I'm curious is your opinion on this, because I hear a lot of cherry picking when we think about inflation indicators. Some, you know, have a bigger weight on housing, some have less of a weight on housing. We know the Fed targets the PCE deflator, which is running cooler than the CPI number, but I don't think that we can just discount the CPI data simply because we don't like what it shows us versus what the PCE deflator does. I mean, how do you sift through really a growing cacophony of different inflation indicators?
Well, it's the old saying about what you see depends on where you sit. If you're sitting at the Federal Reserve, you're looking at the PCE, and you know that owner's equivalent rent in the CPI is a misleading indicator, and it doesn't really necessarily tell you what's going on with inflation overall. So you look through that somewhat. If you're at 1600 Pennsylvania Avenue, you're looking at the CPI because that's what most Americans are looking at, and you're worried because it's still too high. If you're at Health and Human Services, you're looking at the CPI because that's the deflator that gives you what the Social Security increase is going to be the next year. So it all depends on what you're using the numbers for. I think people on Wall Street know that the Fed looks at PPI. They look at CPI. We'll get a reaction tomorrow because they'll be looking at it as sort of an indicator for where PCE will go, but they know that the Fed's looking at PCE, and if it doesn't start going down again, they know we're not going to see any rate cuts soon.
If you are just joining us, we did get that PPI print. It did come in, at least the headline number, hotter than expected, but the market reaction fades as people look beneath the hood and really see that it wasn't that significant of an oversight, of an overshoot based on the downward revisions in the prior month. You could see S&P futures almost back to flat. You could see a similar reaction in bonds with yields almost flat on the day, pretty much across the board as people assess whether this really is something that points to higher inflation, the foreign exchange trade. You can also see a similar type of revision, although again, there's a question of how much the U.S. is going to be ahead, or behind, I should say, of the European Central Bank when it comes to cutting rates. Laura, you said that disinflation has stalled. That is your takeaway. What gives you that confidence when there are certain aspects of this that very much just are a de facto product of the times, like portfolio management fees?
Yeah, you know, when you really look underneath the headline inflation data, what you see is a huge difference now between what's going on the services side of the economy and the goods side of the economy. Goods price deflation is almost back to where it was before the pandemic, but the services component, and our economy is, for all intents and purposes, a services economy, is running much, much hotter. And it's a combination of rent, but it's a combination of a lot of other, you know, the Fed's sort of ostensible super core number that is also a reversed course, and inflation in that area is rising. And so when I add it all up, the resting heart rate of the US economy, sort of outside of that goods price deflation, is significantly higher than 2%. It's higher than 3% right now. And the services piece is what is notoriously stickier. And outside of rents, I think you've got this wage component that is going to keep it all overheated.
Do you think it would be a policy error at this point for the Fed to cut twice this year?
They seem to really want to cut, and frankly, I don't think 50 basis points is going to move the needle significantly on demand. I do think that we should all have confidence in the fact that, you know, our economy is solid today. My outlook is to cut so badly, and they're so focused on the fact that rates are restrictive. When I look cut, but I almost feel like they have boxed themselves into a corner. They seem to want to cut so badly, and they're so focused on the fact that rates are restrictive. When I look at markets, I don't see rates as being terribly restrictive.
Mike, what does this mean, you think, when you take in what Laura is saying about the PPI, CPI, the services? How is the Fed going to be looking at that? I mean, we're going to hear from Powell today. What does he say coming out of it?
They do look at those two things because they're the major ways of looking also at CPI. And services were up 0.6 this month, and goods were up 0.4. It's a little bit of a rise for goods, which is not goods news for the Fed, to make a bad pun. But services continue to rise. They're up 2.7% over the course of the last year in the PPI. So that is an issue for the Fed. Now, whether they want to cut or not is going to depend on what happens down the road. We got CPI tomorrow. We got another CPI on the day of the next Fed meeting. They'll have more information. But while they do want to cut, they are worried about real rates and what they will do to the economy. They do want to cut, but whether they feel they can under these circumstances is an interesting question. And I guess the question, here's a good question for figuring out whether the Fed wants to cut and whether 50 basis points will make a difference. So suppose they cut twice, 50 basis points. What does that do to house prices? House prices, the housing industry just sort of stopped, but prices went up because there's nothing on the market. So will prices go up or will prices go down? That's something the Fed has to try to figure out, and there's no good rule to do that.
Especially at a time where some people are saying that on the margins, high rates have actually been inflationary when it comes to things like housing. Laura, you're going to be sticking with us right now. We do want to get a sense of what's going on elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. President Biden has announced sweeping tariffs on Chinese chips, minerals, and EVs, affecting about $18 billion in imports. It is the most comprehensive update to tariffs on China, first imposed by former President Donald Trump. The changes are set to take effect anywhere between 2024 and 25. Biden will make a formal announcement at the White House later today. OpenAI has launched a faster and cheaper version of its AI model. The new, more conversational version gives users free features that had previously been limited to those with a paid subscription, like the ability to search the web, speak to the chatbot, and hear responses in various voices. During OpenAI's presentation yesterday, the chatbot appeared to translate speech from one language to another almost instantaneously and sang part of a story upon request. Apple is preparing to sell its Vision Pro outside the U.S. for the first time. It'll be testing the appeal of the more than $3,000 mixed reality headset. Apple flew employees to Cupertino, California to begin training sessions. People familiar told us the overseas expansion is likely to include China, France, and Germany. And that's your brief. Lisa.
Thank you so much, Danny and Maria. I wonder what those training sessions are like. Put them on, enter this world, start to go like this, and see what happens?
Yeah, they look pretty wild. Also interesting that they're doubling down and Tim Cook has China for the Vision Pro.
Yeah, well, it's been a real conviction trade for them regardless of some of the headwinds. Up next, we're going to talk about GameStop, we're going to talk about AMC, we're going to talk about the return of the meme stock.
There's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression.
That maybe things aren't as they seem. That's coming up next with Roaring Kidding. No, he's not joining, but we're going to be speaking about that coming up next. This is Bloomberg Surveillance.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
There was drama for a minute, and then it went away. We did get that PPI data, and just we saw a headline number that came in hotter than expected. Then you take a closer look at the numbers, and it isn't as much higher as much as you expected. So a lot of those moves fade. Still, a more negative tilt to the S&P futures this morning, a more positive tilt to the dollar stronger. Well, the euro now actually reclaiming some of that. Yields just marginally higher. Basically, everything retracing to near where it was before. Under surveillance this morning, what else is happening elsewhere, which is the return of the meme stock.
What I worry about it is that it gives investors the perception that all of this is manipulated or none of it is real. And the reality is when you look at the broad market, corporate earnings have been moving up as well with the market. So there's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression.
Here's the latest. Meme stocks, GameStop and AMC are soaring once again. Thanks to the return of trader Keith Gill, or Roaring Kitty. He is not a cat, however. The stocks remain far below their 2021 highs, despite seeing moves of more than 100% in pre-market trading. All it took was a tweet of a rough drawing of a man leaning forward, and it was back to the races. Gina Martin-Adams of Bloomberg Intelligence joining us now, fresh off a trip from Asia, not thinking she was going to be talking about meme stocks, and yet here we are. Even with everything else, with the inflation data, with everything else, we got to start there. Is there some signal here in terms of the mood in markets and the appetite for risk taking?
Well, we never want to read too much into a tweet driving meme stocks, but nonetheless, I do think it's a small part of a bigger picture, and that is some degree of risk tolerance revival that has started to emerge in small caps. This started to emerge 6 months ago. We saw small caps break out of a really consistent range trade that really captured small caps in a bear market, the second longest bear market in small cap history, in fact. And they started to break out a little bit over the course of the last 6 months. We're seeing in fits and starts, small caps start to perform better in general. This also accompanies some IPO activity. Remember, last year was the worst year for IPOs, even worse than in the great financial crisis. We started to see some recovery in IPO activity, and we're starting to see a little bit of recovery generally in risk tolerance. And I think that this is part of that story.
So if we can talk about meme stocks aside and Roaring Kitty, if you haven't watched Dumb Money, great movie, by the way. I am curious, though, about how much that's really just faith in the disinflation trade at a time where the data that we've seen just now shows, you know, albeit maybe not as much of an upside surprise, but as Laura Rame, who's still with us, pointed out, disinflation has kind of stalled.
Yeah, well, I think it's part of it, but remember, disinflation really didn't help small caps a whole lot. Disinflation really started in the very beginning of 2023. It helped select names inside the S&P 500, but it wasn't until late last year when inflation had already started to stall that small caps really started to break out. So I think this is an important clarification of trend is small caps have been in their own cycle really trapped by an earnings recession that really held back risk tolerance there. Now that earnings recession is starting to improve a little bit. We're starting to see a little bit of recovery in the fundamentals. Yes, the inflation story is part of that, but it's not the overwhelming story. You are seeing generally better activity affect small cap earnings growth. And small caps really trade on revenue, so this is not necessarily all about inflation.
So we've just written a lot about small caps recently, and the fact that you've really had a much broader sort of 20-year trend of deterioration in quality in small caps, and a lot of this is due to companies staying private much longer. How much do you feel that small caps are really reflecting what's going on in sort of the broader markets and the broader economy? You know, I look at, you know, sort of this giant now private middle market, you know, private equity, private debt opportunity. And the Russell 2000 seems increasingly dominated by sort of venture capital backed IPOs, sort of moonshot tech companies. You know, there's opportunity if you get it right, but overall fundamentals aren't great.
Yeah, I would agree. And the sort of lack of IPOs has been the biggest reason why small caps have struggled relative to large caps. Not to mention the large cap companies, especially in the tech space, own all of the private sector or own the biggest companies in the private sector, which prevents them from IPOing in the small cap space. But we are seeing IPOs recover to some degree this year. And even though it's de minimis, it's better than nothing, which is what we had in 2023. And I think that that's helping risk tolerance. The other thing to consider about small caps is it's a whole lot of healthcare. And healthcare just went through a massive turmoil reflecting the pandemic conditions. Big upswing, big downswing. Healthcare could recover this year. That's a completely independent space relative to tech, not owned by big cap tech, could fuel some degree of optimism in small caps that we really haven't had for a very long time. The other thing to consider is just the leverage in financials. You know, remember, last year we had bank failures. This was a huge drag on small caps in 2023 that presumably starts to go away in 2024, somewhat dependent upon what the Fed does, of course.
Yeah.
We'll see where they head. But there are some moving parts in small caps that would suggest we're due for at least a little bit of recovery in this space. And we're starting to see it emerge. It is not by any stretch of the imagination robust or pervasive. It's in fits and starts. But it is a very different climate than we've been in for the last 2 years for small caps.
Does that say to you then, if you look at small caps, that we're sufficiently restrictive in this market?
Yeah, it's a really, really tough space because there's not a lot of options, right? There's no IPOs, there's no new supply. The small caps thrive in an amount of supply. They love supply. They love new options, new growth. There has been none. So it's very difficult to find your investment strategy in this space. You need the growth, you need the new supply of growth, and we haven't had it. So we need to see that to some degree. If we can't get it, it's really difficult for small caps to perform well.
Just taking a step back right now, it seems like we're trying to play around with a couple different narratives today. We're trying to understand what fiscal policy and tariffs really have to do with some of the investment themes. We're trying to understand where we are in the cycle.
Yeah.
And it's kind of head spinning. And I get the sense a lot of people have checked out from all of it and are just saying, look, I like these companies.
Yeah.
They do this well. And you know what? It's nice to keep an eye. How much is that really what you're hearing when you travel around and talk to clients?
It's pervasive. There's this underlying tone of stress related to the macro forecast. Over the last 2 years, the macro forecast has told us only to expect worse and worse and worse, and yet we had an entire cycle play out in the earnings environment. So it has taught us the hard way as investors what really drives stocks is earning trends. You have to pay attention to the earnings cycle, which is not always driven by the macro cycle and is not always easily forecasted by the macroeconomic forecast. And so I do think that this is becoming a very consistent topic. One thing that we noticed coming into both 2023 and 2024 is what was priced in the equity market according to our models was much closer to a macro forecast than it was to the bottom-up consensus. This year, over the past 4 months, we've started to see the market increasingly move toward the bottom-up consensus as its guidepost. It's not there yet. As our best guess is the market is priced for about 6% earnings growth, where the consensus is telling us 13%. But the macroeconomic forecast is still implying less than 2% earnings growth. So the macro's gotten it wrong. Effectively, the macro's missed an entire earnings cycle, and that's getting reflected in investor expectations. You cannot overly rely on macro forecasts to drive your investment strategy. We learned that the hard way in the last 2 years. You have to pay attention to those individual company dynamics.
And sometimes to roaring kitty. Gina Martin-Adams, thank you so much for being with us. Laura Rame of FS Investments. Final thoughts as you assess PPI and as you assess some of the sort of motley slew of narratives.
Yeah, I continue to really think that the big focus is tomorrow. The CPI data, I think, are going to show this continued trend that disinflation has stalled. And I think from here, it's so critical to recognize, and this speaks directly to what Gina was just saying, that today, expectations around the economy are very positive. I would almost argue that it's optimism at full throttle. And that is a time when we just need to recognize that probably all of the good news on the macro side is priced in. It doesn't mean that we may be in for some huge stumble, but I do think it is a time for caution because everything is so stretched.
Which means go into GameStop. No, that was not a recommendation, but that seems to be what some people are doing. Laura Rame of FS Investments, thank you so much. Coming up at 3 p.m. Eastern on the close, U.S. Trade Representative Katherine Tai, at a time where there's quite a bit of strain given the fact that that announcement of highly expected tariffs on Chinese electric vehicles was announced. Tomorrow we have Evan Brown of UBS, Ed Yardeni of Yardeni Research, as well as Tom Porcelli of PGIM.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
From New York City, for our viewers worldwide, I'm Matt Miller. The countdown to the Open starts right now. Coming up on this Tuesday, U.S. PPI hotter than expected, so the inflation picture still looking a little bit hawkish, sending yields higher ahead of Chairman Powell, who will speak later, and raising concerns about upcoming rate cuts. Obviously, that's the issue for these markets. We begin with the big issue, more signs of stubborn inflation.
Disinflation has stalled. I think that's the trend that I continue to see. And when you look ahead, you know, we've had a lot of tough talk out of the administration about tariffs. You know, the little relief that we're getting on the inflation front is more coming from goods. And that looks unlikely. That sort of global trend of lower goods prices seems unlikely to stay with us, as, you know, sort of all of the low-level news that leads us to create our top-line CPI forecast is just continuing to push higher.
We still have a relatively mixed picture in terms of futures, so it doesn't look like the PPI report has pushed us down too hard. Joining us to talk about it is Nuveen's Saira Malik and James Camp of Eagle Asset Management. Saira, let me start with you. What do you think as far as you know, the inflation picture? Again, as Lara Rain was just saying, disinflation has kind of gone away. Maybe inflation is back in the picture. Is the Fed going to raise rates and hurt the rally that we've seen in stocks?
Well, first, let's start with PPI. We need to look at two things here. How does it translate to PCE? And really, what is this? If we parse the data, what does it mean? So first, on month-over-month PPI, it looks hot, but much of that is because March was revised down. Year-over-year is more in line. So I don't think PPI is as concerning as it looks on the surface. And then second of all is, how does it translate into the Fed's preferred barometer of inflation, which is PCE? You know, most of the metrics were actually pretty tame, except for portfolio management, up almost 4%. So I'm less concerned about the PPI translation to PCE, but I am still concerned about CPI, which may make baby steps towards moderating tomorrow, but I don't think CPI is going to be enough to change the Fed's path to less rate cuts this year rather than more.
James, what do you think?
I think the inflation data has been menacing for the Fed. I think they've got a lot of things wrong, and I think the main takeaway that I have is it's a different economy than it was pre-pandemic. Labor market is different, supply chains are different, and producers now have pricing power they've never had, at least after the financial crisis up until the pandemic. So I just think there's a lot more inertia to inflation that is being given credit for. I think a lot of the data series are going to have some easy base effects, so the headline data will come in higher. And I think the Fed is going to be really, really tough to justify moving policy lower from a rate standpoint, because they haven't hit that mandate yet on the 2%.
By the way, James, what would you buy if you were worried about inflation? I mean, what's the number one asset you think is the best place to hide in if you're worried about inflation? Is it still gold? You know, is it Mag 7 stocks? Is it a Bitcoin?
Well, I'm going to defer on the crypto, but I would say that companies with great balance sheets, pricing power, and that can raise income in the form of dividends, that's the best inflation hedge historically. If you want to protect your purchasing power for the goods that you consume every day, own some of the great companies that produce those, because they still have pricing power and dividend acceleration and dividend performance. I think is going to really have a great year in 2024.
Sarah, what do you think? If you were worried about inflation, and obviously tomorrow when we get the CPI print, we'll have a better look at where inflation is going. It certainly seems like it's still going to be up above 3% on the headline and even higher in the core. If you were worried about inflation, where would you hide?
Well, I agree with James. Looking at quality companies is important. I am worried about inflation. I think it's sticky and it's going to be here for longer than investors hope. So two categories: dividend growers, like James mentioned, and also infrastructure companies. So starting with dividend growers, these are these high quality companies with strong balance sheets. They tend to raise their dividends over time so that these companies have strong fundamentals. If you look at market returns, in down markets, they tend to outperform historically, and in up markets, you capture most of that upside. So they're a nice defensive play for equities. Infrastructure companies tend to be inflation hedges because of the kind of contracts that they have. Now, also, they have a lot of tailwinds with where the U.S. is going. Number one, bringing more of our manufacturing back home needs more infrastructure. Second is also, as we move to more renewable energy, we need to upgrade our grids. That, again, is more infrastructure. It's less economically cyclical because the components are mainly utilities and waste management. We still turn on and off our lights and take out our garbage during a recession. Those are two categories I think that you can use to balance the other side, which is the mega cap 7, which should continue to do well even in a slower economy. But given their premium valuations, I think you need to look at lagging sectors like dividend growers.
Are we looking at a slower economy? I know the GDP print last time was below 2%, but people are raising their expectations for GDP this year. I think the average right now for 2024 is like 2.5%.
But I think looking at three things: GDP, manufacturing, and employment markets tell you the economy is moderately slowing. So first, GDP, as you mentioned, first quarter GDP missed consensus expectations. Manufacturing data, some of the manufacturing data we've seen recently says that the economy is in contractionary territory. Employment is very important here because that has been one of the key drivers to this economy. Just last month's payrolls came in under expectations, and claims last week actually bumped up. We've been in this range of about 210,000 to 212,000 for claims for about the last 2 months straight. Last week, that number jumped up again. So it's one data point, but it is telling you maybe we are finally seeing some incremental slowdown in the employment markets.
James, you also think we're seeing a slowdown in this economy, or we will see a slowdown in the economy?
Yeah, Mangus, and I think it's here for the down market consumer. If you look at the bottom, 80% of Americans, their budgets are stretched. Credit card debt's accelerated. This regressive nature of inflation is caught up. Down market retailers are struggling. I think you're going to have a material slowdown Q3, Q4. These Fed policies will have a bite. They're biting small business. They're biting, as I mentioned, the down market consumer. Where they're accretive is the large companies with massive free cash flow that can sweep their money into 5.5% money funds. And the other part of the story, I think, is this government impulse, this fiscal impulse that we've been kind of living with over the last couple quarters has accelerated GDP higher than it otherwise would have been. And what's problematic about policy is we're deficit spending massively into an expansion. And I think all of that is gonna come to a pretty harder landing in the back half of the year than I think most are expecting.
All right, so income investing here firmly back for both of you. I want to take a moment to focus in on that PPI report right now, coming in hot with plenty more data to come this week on the inflation front. Bloomberg's Michael McKee joins us now for more. Mike?
Matt, let's take a look at the headline numbers that did upset the markets. However, briefly, as we saw the PPI headline and the core X trade come in hotter than expected, much hotter than expected, although on a month-over-month basis, the PPI headline didn't move a whole lot. But you look at those revisions to March, and it leaves us with a little bit less of an index change than we would have had, but we also do see stronger producer price gains than we thought we would have. I threw in NFIB small business. You were just talking about whether the economy is slowing, and while the small business people think that the outlook isn't great right now, they're feeling more confident than they were last month. All right, let's take a look at the CPI, PPI, and PCE and what they've been doing. You can see the white line. That's PPI, and it has been rising much faster than the CPI and the PCE, at least if you look at it on a normalized basis, and that was particularly true this month. But as you can see, CPI, the yellow, not rising as fast, still rising. What's going to happen to it? And what's going to happen to PCE, which is the number that the Fed is watching? Well, there are a couple of things that go into the PCE from the PPI and CPI. Among them, home health care and hospice, which was up only 0.1% after a 0%. Healthcare is a major part of the CPI. Portfolio management, this is the POGO index. These are the people who get paid more when the markets go up, and you can see what happened. And I'm looking at you, equity guys, because the yellow line is equity, and that's you're the ones who are making the money right now. Bond managers not doing quite as well, but that's part of the problem. That'll go into CPI and PCE. One thing I left out, though, Matt, is airline fares down 2.3% on an unadjusted basis. Seasonally adjusting that for the CPI and the PCE could mean an actual lower than expected number for those indicators for the month of April. So we're going to have to watch that.
All right, Mike, thanks very much. Michael McKee there, Chief Economics Correspondent, looking at the actual PPI report that we got it at 8:30. We're going to get the CPI, obviously, tomorrow. I'm talking with Sarah Malik at Nuveen, as well as James Camp at Eagle Asset Management. One of the things people are starting to talk about again is stagflation. And as you're both worried about a slowdown in the economy, and Sarah, you point out you're worried about inflation as well, where does that leave the Fed? What do they do if we do have slowing growth and an inflation nut that they just can't crack?
Well, that's going to be a challenge for the Fed. And, you know, when CPI comes out tomorrow, I think if the number is above 0.4%, that will increase that stagflation narrative. That's going to be where inflation is just continuously staying sticky and hotter than expected. And now we're seeing the other side of that with slowing manufacturing data and some uptick in unemployment, which could be concerning. I think stagflation would be an issue, look more like the 70s. That'll delay Fed rate cuts. You know, we were always in the camp of 3 or less rate cuts for 2024. I'll take the under on that. I think we're probably going to get 1 to 2. Let's also not forget that during an election year, the Fed tends to do less, not more. So as we get closer to that November election, I think the Fed will likely just hold back and do nothing because they don't want to look like they're influencing the election. So that gets you to maybe 1 rate cut later this summer. And if not, we're probably waiting till December. And they're not going to cut rates until they see some signs of inflation consistently moderating, and we're not seeing that yet.
James, what's your Fed expectation? I mean, I know it's kind of a parlor game, right? And it's a moving target. But as Sarah points out, in an election year, their hands are going to be tied for at least a few months.
Yeah, I think the calendar is not in their favor. We've sort of been of the belief that the Fed doesn't need to cut, shouldn't cut, if they're true about the mandate of inflation. The likelihood, though, Magnus, in this environment is that we're not going to get to 2%. The period that was the decade prior to the pandemic, I think is going to be the historical anomaly with goods deflation, with companies chasing low costs around the globe. That model's changed. And I think we just have to realize as investors and as a population that the economic model is different, the labor market is different, supply chain is different, and that a normal rate of inflation may not be 2%. I think the Fed's going to ultimately have to pivot to that narrative. I think the big problem with policy is it is continuing to bifurcate the economy. Maybe a more subtle point, but it is accretive, as I mentioned, you know, to companies with massive cash flow. It's accretive to high earners and wealthier people that can invest in short-term instruments at 5.5%. And it's really adding to the inflation burden, down market consumer and small business. I think that's where policy gets really tricky.
I got to ask you about the market specifically, James, as we get closer to the open. And, you know, I know this sort of frothy stock, meme stock picture may not be your bag, but you deferred on Bitcoin, and I'm looking at GameStop right now, indicated to open at $66, so doubling and then some, again from yesterday. 2 weeks ago we were at 10. What do you make of the high price of these kind of assets, Bitcoin, GameStop, AMC, what does that mean to you if investors are driving these up?
It tells me there's more liquidity in the system than people realize. You see that in a lot of different markets. We see oversubscribed corporate bond markets, oversubscribed treasury auctions. These sort of phenomena with the meme stocks are perhaps interesting. I just defer back to the tried and true that we do. At a Fed peak, we know a couple things. One, 3 and 5 year bond returns are excellent. 1, 3, and 5 year dividend growers are excellent. And for people that are investing for the long term, investing for retirement, the income landscape has not looked better to us in a decade or two. And I would stick with that, the fundamentals, individual companies, kind of knowing what you own. If you want to play in these other things, carve out a piece, let it be your play money. But the center of the plate investment universe looks really attractive to us right now.
I know, Sarah, you like Fifth Third Bank in terms of stocks. Give us the elevator pitch as to why.
Sure. So bank stocks here also in an elevated interest rate environment where rates are peaking. Bank stocks are starting to look more attractive. You can see that with the technicals, where regional banks are starting to look more promising. Fifth Third in particular, very nice geographical exposure with its southeastern footprint. Also, net interest income is strong. Delinquencies have not been very elevated, and also cost cutting good for Fifth Third Bank. So we just love the geographic positioning, the growth prospects for them, and in an environment where we are finally moving past rate hikes and more towards rate cuts, this is good for generally the regional banks.
All right, Sarah, thanks so much for joining us. Sarah Malik there, as well as James Camp from Nuveen and Eagle Asset Management, respectively. Great to spend some time with you on this Tuesday morning. Joining us now with a look at the other stocks that are moving ahead of the open, here's Abigail Doolittle.
Matt, it would be hard to not take another look at those meme stocks. And of course, the rally set off yesterday by the potential return of Roaring Kitty. That is the name on X of Keith Gill, who set off the 2021 big rally for some of these meme stocks. And you can see, as you were mentioning, GameStop at $67, its highest level since 2021, up 121% after rallying 74% yesterday. AMC going along for the ride. As for some stocks that are not going higher, Home Depot right now down about 1% in the pre-market. This as sales have dropped for a sixth quarter in a row amid housing market woes and, of course, do-it-yourselfers not being quite as active. Coinbase down 2.5%, and this, of course, with Bitcoin down, but we also had an outage that ruffled some of those crypto markets. And then finally, Alibaba, after trading up more than 5% over the last 3 trading days, into today down 4.7% on a quarter that's being seen as somewhat disappointing given huge investment losses, Matt.
6 quarters in a row of declining revenue at Home Depot. I was there last night.
Was it busy?
Yeah, it was busy.
The one downstairs often is.
Not as busy as it was during the pandemic, and that's the issue. Abigail, thanks very much. Abigail Doolittle with a look at stocks, just about 15 minutes until the opening bell. Coming up, the U.S. consumer under pressure.
The consumer, when you look at credit metrics, you look at the savings rate, yeah, things are softening a bit, but they're still not terrible.
Higher interest rates are the problem. We dig into Home Depot's latest results, deeper into Home Depot's latest results. Next, this is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Broadly speaking, the consumer has softened a little bit, which makes some sense given all the pressures that are out there. However, generally speaking, you see total retail sales are still up a couple of percent. Some of that is inflation, I get that, but the consumer, when you look at credit metrics, you look at the savings rate, yeah, things are softening a bit, but they're still not terrible.
The consumer is in focus, again, as retail earnings ramp up this week, really ending earnings season. Home Depot, one of the big ones, reporting a sales drop for a 6th straight quarter amid weaker demand. This comes ahead of Walmart earnings out on Thursday. Joining us now for more on the retail landscape is Bloomberg's John J. Edwards III. And John, I was just talking about this with Abby. I know, I was at Home Depot yesterday. It was pretty busy, but not as busy as it would have been during the pandemic. And I guess that's the main issue, right?
Yeah, it's exactly that. They're still coming off of that strong performance they had during the pandemic when everyone was stuck at home, improving their homes and, buying lots of big ticket items. They've now bought those big ticket items, and that plus inflation means that they are really not shopping for those high dollar items anymore at the moment. Some analysts are expecting to see Home Depot come back, toward the end of the year. But it's still a rough period for them with that combination of, consumers pulling back plus, persistent inflation.
What needs to change here? I mean, is a rate cut really going to help if the Fed cuts 25 basis points or even 50 by the end of the year? Is that really going to help Home Depot?
That's a good question. I mean, there's the extent to which it maybe spurs, some more home activity. I think a lot of people are feeling like Home Depot itself is actually not doing that poorly. They really are at the mercy of a lot of these macro factors. But the company itself is seen as reasonably well run and just kind of riding out this period. And, we'll, again, probably get to somewhat better results as we get into the end of the year and early next year.
Well, it's down almost 6% year to date as the market's up about 10, so really underperforming the S&P so far year to date. John, thanks so much for joining us. Bloomberg's John J. Edwards III there talking to us about Home Depot. Of course, Walmart out on Thursday, which is a real economic bellwether as well. Right now, I want to get to the Qatar Economic Forum. It is in Doha, where Bloomberg's new economy editorial director, Eric Schatzker, is sitting down with Citadel's CEO, Ken Griffin. Let's listen in.
Global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage. And that goes with this rise in geopolitical complexity. So I think that's certainly true, that there are just larger tails today that didn't exist, or we didn't perceive them to exist 7 or 8 or 10 years ago. So that is intrinsic in money management today, and that's something that we think about each and every day at Citadel, is how do we mitigate the tail risks in this world?
How do you mitigate the tail risks?
Well, part of it's sizing. So part of it is how much exposure will you have to a strategy or to a particular sector of the economy or to a particular country. That is the go-to playbook for managing your tails, is just what's the most you're willing to have exposed to a possible adverse event. And then the other strategy is to look for correlated payoffs that will protect you in the event that the tail scenario occurs. So those are two things that you do in your portfolio construction to manage against the tail risk in this environment.
Ken, moments ago you mentioned China and EVs. As it happens today, the Biden administration is levying sweeping new tariffs on Chinese imports, including on electric vehicles. How does that change the picture?
Well, it's sort of a continuation of the incoherent economic policies of the Biden administration. We've seen this giant push towards green energy over the course of the last several years, and at the same time, a set of policies that run completely contrary to the stated goal of trying to head towards a zero carbon world, and placing enormous tariffs on Chinese EVs, which are low cost, high quality, of great value to American consumers, is yet another part of the incoherent Biden economic strategy. The other part of the strategy that I scratch my head about is the U.S. refusing to provide new LNG permits. Right? If you want the world to head towards a lower carbon footprint and move away from coal, access to LNG is a really important part of the equation. And yet the United States is refusing to permit new facilities in the foreseeable future.
And also to sell LNG to countries with which the United States doesn't have a free trade agreement.
That's a part of the equation also.
That said, the United States, amazingly, is a bigger LNG exporter than Qatar.
We're neck and neck. We're neck and neck, and it's very important to understand that if you want a country to base its economy on natural gas, they're going to want two suppliers. It's not a win-lose dynamic between the United States and Qatar. It's a win-win. If you look at any good that is required on an existential basis, you're going to want dual source supply, and the rise of the United States as a major LNG exporter only strengthens the position of this region of the world in providing natural gas to other countries.
Going back to China for a moment, we've talked about China in the past. You have what I would call a constructive view of China, certainly more constructive than many people with whom I've spoken. There is, however, strong hostility to China among both Republicans and Democrats. So how would you explain the way you look?
That is Citadel CEO Ken Griffin talking with Bloomberg's Eric Schatzker. That's right now live at the Qatar Economic Forum. You can continue to follow the conversation from the QEF on the Bloomberg terminal. Just type LIVE go, live go, to watch more from Ken Griffin and Eric Schatzker. The Open is next. This is Bloomberg.
we're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building
mutual pain. And that's a difficult place to be. It makes the Chinese wary of trusting the United States. It makes the United States wary of trusting China. And there's just a lot lost in that equation.
It would make sense if what the United States wants to do is make an enemy of China, but that's not clear.
Well, I don't want to make this a U.S. only is going after China. It's a two-way street. I mean, the Chinese, for example, supporting Russia's ability to wage war in Ukraine doesn't play well in the United States of America. So there's room for both countries to take definitive acts to just turn the temperature down. And, well, if it's a cold war, then it's to turn the temperature up. I'm not sure which way you go. But to improve the relationships and the dynamic between our two countries.
Ken, Qatar is playing an instrumental role in the peace talks, or the effort to create peace, as it were, between the Israelis and the Palestinians, and to resolve the situation in Gaza. And with respect to Hamas, you've been outspoken about the pro-Palestinian protests back in the United States. They've roiled university campuses. You've been particularly critical of your alma mater, Harvard. Here's my question to you. When people here in the Gulf region, and across the globe for that matter, see the chaos at Harvard or Columbia or USC or MIT, and police in combat gear moving to clear encampments, how do you think that shapes their view of America?
Not well. Not well. And what is lost is that what's happening on campus is not free speech, it's anarchy. You know, at Columbia, when they storm a building, they vandalize a building, they're destroying property, and then they ask for humanitarian aid, which is the greatest of all ironies. It's just the wrong dynamic that we're seeing take place on American campuses. These are students, most of these students on campuses are trying to learn, they're trying to have an education, and the universities should be really trying to encourage a constructive debate between the students of different backgrounds, whether they're from the Middle East, whether they're of Jewish origin. It's really important that the generation that will be the generation that runs the world in 40 years tries to learn from this horrible moment in history. And we're not fostering that environment on campuses today. And it's really, it's a huge, huge disappointment that so much of what we see on campus, you've seen the video footage of the kids interviewed. Why are you here? What are you protesting about? Often they can't even answer basic questions about what's happening in the region and why it's taking place.
Ken, people here, and I suspect those watching us around the world, are eager for your insights into what might happen during and after the U.S. election. How might U.S. foreign policy and defense policy change if Donald Trump were to return to the White House?
So if President Trump returns to the White House, I think you'll see a global perception of a stronger America. Now, the Biden administration's foreign policies, the actual policies, are generally speaking thoughtful. But to be blunt, America does not exude credibility or strength in its actions around the world today. Our positioning does not match the thoughtfulness of our policies. That's a very difficult place to be in a world which has the geopolitical cross currents that we spoke about earlier. And it means that those who are willing to push to see how far you can push America are willing to push harder than we want to see happening. And I think that anybody who knows President Trump knows that is not somebody you just push to see what's going to happen. That's the wrong strategy with President Trump. And so I believe that President Trump will have very good people in foreign policy and in the Department of Defense, but I think he will exude a level of strength that will help to stabilize the world in this very, very trying times.
There has been flagging support for aid to Ukraine in the Republican Party. Would Donald Trump abandon Ukraine?
No, he will not.
You're certain of that?
Well, this goes back to my earlier statement. You could never be certain about President Trump. And that's part of the reason that he is more intimidating to our adversaries. You never know exactly what the response is going to be. But knowing a number of people that he's close to and having actually brought this topic up, I think that President Trump feels he can find an off-ramp towards peace by reaching across to Putin and to the Ukrainian leadership. I believe he knows it's important to American interests that we do not abandon the Ukrainian people at this very difficult moment, and that we keep Russia's territorial ambitions in check. And a strong pushback against Putin will be part of the equation, if need be, to secure the peace in Ukraine.
What do you think he'll do with economic policy?
That's difficult to know. So neither administration gives me comfort in terms of a willingness to reduce federal spending. But I have no doubt that a Trump administration would be far less oriented towards regulatory overreach and far more thoughtful about the role of the U.S. government in the day-to-day U.S. economy. You know, one of the reasons that American voters are so unhappy right now is inflation is out of control. And inflation is out of control because of the expansive government under the Biden administration, the rate of spending, and the degree of intervention in the economy. It's causing energy prices to be higher. It's causing the cost of manufacturing to be higher. It's impacting every part of the economy in a way that the American voters are frustrated about. President Biden doesn't understand you need to break the back of inflation to give people the sense of economic security.
We have talked in the past about America's tendency, shall we say, to spend more money than it generates in tax revenue. And you have warned, Ken, of some catastrophic consequences if deficit spending isn't brought under control. What is the catalyst for an American debt crisis going to be?
So I don't know what that moment will be when there's an auction that goes awry or when the markets become dislocated. Financial markets, generally speaking, work very well until they catastrophically come off the rails. You don't necessarily get a lot of warning that there's about to be a big event. The crash of '87 is a great case study. You know, that day I woke up, I was in my dorm room trading then, and the stories of the day were about a small skirmish in the Middle East of frankly no consequence, and the health of First Lady Nancy Reagan. And yet we ended that day with the stock market down 20-some% and a number of American financial institutions literally on life support or near death. Happened in one day. One day. There was no big story that morning that would make you think that that day might have been the end of the U.S. capital markets as we knew them. There was no warning. And so I worry that the debt crisis may have a similar construct, that there'll simply be a day where a major auction fails, and then you see a panic start to brew in the Treasury market. And the question will be how fast will the Fed intervene? What panic will that induce? Because government intervention under duress often just creates more panic. And then do we see a flood of treasuries coming back into the market from holders around the world?
It's a frightening prospect.
It is.
Back to politics for a moment. You've been a prominent donor, I would say, to Republican candidates. I'd like to know, how are you going to spend your money? How are you already spending your money ahead of the election in November?
So I have been a significant supporter of Republicans that stand for personal freedom, national security, and economic soundness in the United States. That has been a big focus of mine in this primary election, or this primary cycle. I want to see people in the House and in the Senate that represent the best of American values and backgrounds that prepare one to serve in public service. In the last election cycle, I supported a number of people who were veterans and who are now serving our country in the House, and they do it with the pride that our country deserves, and they do it with the integrity that our country needs. So I've been very focused on finding candidates who I think represent the best of American values to be part of the future of the Republican Party.
People probably want to know, have you donated to Donald Trump's campaign? either directly or indirectly to a PAC or a super PAC?
I have not.
Will you?
I'm going to wait to see who he picks as his VP candidate.
Is there anyone whom you'd like to see him pick as his VP candidate?
I don't, this is again like poking the bear. Not sure which way my recommendation goes in terms of helping that person's prospects.
I think that's a wise position to take. Before we finish, Ken, this region is blessed with resource wealth and, as a result, sovereign wealth. So much so that pretty much every major asset manager in the West sees the Gulf as something of a honeypot and is trying to raise money here. As someone who isn't raising money here, how would you advise the sovereign wealth funds in the Gulf region to maximize their negotiating leverage?
So either I'm going to be excommunicated from the circle of my fellow money managers, or never invited to come back to the Middle East again. Is that the position you're putting me in? So look, here's what I think is important to think about. I think alignment between the interests of the money manager and the sovereign wealth fund are very important. And I think it's more important to have your money entrusted with a firm that is going to act continuously in your best interest as an investor than it is to try to pick somebody who simply has the lowest fees or some other superficial demarcation of being open and transparent. I mean, let's be clear. Your money managers who have really important intellectual property aren't going to be unduly transparent. They're trying to protect their very intellectual property that they'll share the benefits with the client. Simply put, Coca-Cola doesn't publish its recipe on the web. So I think it's very important when you find a money manager, you're really asking, what's their competitive advantage? What's their culture? How aligned are they with me? And in the good moments and the bad moments, are they going to put themselves in the shoes of their clients and make the right decision by their clients? You know, at Citadel, I take great pride that almost over 20% of the capital in our hedge funds is the capital, the partners, and the team members at Citadel. We wake up every single day as co-investors with our capital providers. And I think that symbolizes what I would think about looking for if I were a member of the sovereign wealth community here in the Middle East.
One last thing. Among the many distinctive qualities that Citadel is...
Just by the way, when you're going to go pick a brain surgeon, do you find the doctor with the lowest fee?
That's not what I would do, no.
Right, so you want to find somebody who actually has pricing power because other people perceive them to be good.
It says something, yes.
There's something to be said for that.
I was just going to say, because I think it would certainly interest people in this room and elsewhere in this part of the world, one of the things that Citadel is known for is how seriously you and your colleagues take the search for extraordinary talent. A number of investment firms have opened offices in this part of the world, whether it's in Doha, whether it's in Abu Dhabi, Dubai, for example, or Riyadh. Have you thought about expanding here?
Well, we actually just recently did an analysis of our competitors' footprints in a number of these cities as we try to think about what is our strategy here in the Middle East. And you landed on the right issue. It's about talent. And when we think about our Middle East strategy, we're going to think about where are we going to draw the greatest amount of talent, both from the domestic country and from the international community. Too often, countries try to attract talent by having very attractive tax attributes. That tends to draw in a handful of senior PMs, but doesn't draw in the analysts and the associates who do the day-to-day work that's required to be successful in the markets. You know, one of the reasons that I think Citadel has been so successful is the intense collaboration that we have within our four walls. A PM working side by side with an analyst, with an associate, working through a problem. Having a PM located in a low-tax jurisdiction on Zoom intermittently with a team back in London, that's not a winning formula. So when we think about where we're going to be in the Middle East in terms of our footprint for human capital, it's going to be about a holistic solution where we've got people who are in the region integrated tightly with PMs who are here. The whole team is here. and successful as a team.
It explains a lot. Ken, thank you very much. Ladies and gentlemen, please join me in thanking Ken Griffin.
Thank you, Eric.
That was the Citadel CEO, Ken Griffin, speaking with Bloomberg's Eric Schatzker at the Qatar Economic Forum. Very interesting panel in terms of his views on, I guess, politics and economics, as well as the war in Ukraine. Right now, though, let's get to some breaking news back here in the U.S. on markets in tech. Joining us from the West Coast is Bloomberg Tech's Ed Ludlow. And Ed, we are hearing about a change at the top of Amazon Web Services, AWS, a hugely important unit of that company.
Yeah, Adam Zalipsky is going to step down as CEO of AWS, Amazon Web Services, the cloud unit, effective June 3rd. Matt Garman, who's been at AWS since 2005, will take over in the CEO role. In a letter to staff and shareholders, Andy Jassy, who's the overall CEO of Amazon, said that Adam Zalipsky has decided to take a next step in his career and move away. AWS is just so critically important, right? And Adam Zalipsky leaves AWS in pretty rude health. $100 billion revenue run rate. He's really made AWS the mainstay of Amazon's cash flow. It's basically the majority of operating income, right, away from Amazon's other e-commerce, healthcare, and logistics offerings. And so it's an interesting change. When the news broke just before the market open and into the market open, shares did decline by around a percentage point. We're down 0.9%. This is Adam Zalipsky, according to the communications Amazon's put out, doing this of his own volition. He's kind of an interesting guy. He himself was at AWS on the early days, 2005 as a VP. He later went to lead Tableau as CEO, then returned to AWS to lead as CEO after Andy Jassy took the reins at Amazon from Jeff Bezos. So he had a pretty good 3-year stint there. Matt Garman's interesting. He started as a very junior sort of MBA hire in 2005, held a number of roles, long serving. We need to kind of learn a bit more about him, or at least the market does, based on the negative reaction of the shares down modestly 0.8%. But again, Zalipsky leads AWS in rude health. And you don't see much divergence of the strategy, which is basically be the market leader in cloud, provide the compute for developing large language models and AI. And as we learned on the call just a couple of weeks ago, Amazon is now making revenue out of generative AI with a revenue run rate in the billions of dollars itself. And that's where Adam Zalipsky leaves AWS.
All right, very interesting stuff indeed. Ed Ludlow there from Bloomberg Tech can catch his show in just a couple of hours, and I'm sure they will zero in on this Amazon issue. Coming up, we're going to speak with BlackRock's Kate Moore to break down this morning's PPI data, inflation data, CPI, of course, coming out tomorrow. How does the market see this? How does the Fed react? This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? I mean, like, what's that about?
We're not forcing everybody to, be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
BlackRock's Kate Moore joins us to weigh in on the equity market. She has written, even after a solid first quarter reporting season, equity sentiment remains tepid as concerns around sticky inflation, cracks in the consumer, and policy uncertainty weigh on risk appetite. She joins us now to expand on that. Kate, I gotta say, I'm just back from 6 months of paternity leave. The equity market looks pretty strong to me, especially considering the slowdown that we expected when I left. Does 5,200 not look tasty?
Well, Matt, I'm talking about sentiment today relative to where it was at the end of the first quarter. You know, we've come off the boil a little bit in terms of enthusiasm. But yes, of course, the equity market looks much better than it did 6 months ago. I will tell you, I was pretty bullish 6 months ago, and it felt a little uncomfortable at times. But most of the data we were seeing was suggesting not only no recession, but actually continued strength on the corporate side and a real focus on delivering earnings. So I think we've been in a good place, but more recently, as I mentioned in that note, you know, we've seen these three things weigh really heavily on overall investor sentiment. That first being, you know, sticky inflation, of course, today's PPI, I don't think really is going to go a long way to help sentiment there. The second is like what consumer companies and even kind of broader companies have been saying as they've been reporting first quarter earnings, sometimes noting significant cracks in the low-end consumer. And then the third, of course, is, you know, given the fact that this is an election year and given the fact that it's a very complicated decision for the Fed, what kind of policy adjustment can we expect in 2024? So I think people are using these three things as an excuse to maybe sit on their hands a bit. Not necessarily cut risk, but sit on their hands.
There's a lot of moving parts, obviously. As you note, the first quarter earnings season was pretty good. Indeed, analysts have been moving their earnings estimates up for the second quarter and for the full year. We've had 3 back-to-back quarters of earnings expansion after 3 quarters of contraction before that. It seems like companies have been doing well despite the Fed. But the consumer, I guess, is the bottom line, the biggest issue for you. How do you expect the lower end or even the middle consumer to do throughout 2024?
Yeah, let me just go to that point on earnings really quickly, which is you're right. Earnings came in the first quarter much better than expected. When we saw the price reaction of stocks as the companies reported their earnings, we sometimes saw a very tepid response. I'm kind of into that word at the moment, tepid response in terms of price action, because a lot of times these companies were not meaningfully raising guidance. They were reaffirming guidance they'd already given, and the market wanted something even more. So good results, really solid prospects, but it didn't raise guidance, and that didn't inspire a lot of new money to work. I think that's an interesting and kind of healthy environment and set up into the second quarter as we deal with some of these economic data, consumer, and Fed policy concerns. Your question, though, is kind of about, what do we do around inflation and the low-end consumer? And this is a huge conundrum, and one of the reasons why I jokingly, but not so jokingly say, I think being on the Fed and being a Fed decision maker at this time is incredibly difficult. Because in aggregate, I know you guys were talking about this earlier, the consumer data looks strong, right? We end up having a consumer whose debt burden is not too onerous, that when you look at even mortgage debt payments as a percentage of disposable personal income, it's kind of in line with a very long-term average. But of course, these averages, we know, don't tell the story. And this is why people have been so focused on the anecdotes from companies talking about kind of the lower 2 quintiles. We'll call it the bottom 40% of earners. And they've said, these consumers are visiting stores less often. They've changed some of their purchasing habits. Maybe the basket of goods that they're purchasing is smaller. So all of those things are raising some flags. I think what we do here is, in terms of our consumer exposure, is stay up in quality and stay up in kind of consumer preference towards higher income households. But we watch very closely to see if policy has to adjust for these lower end households.
I see that, obviously the pressure on the lower end consumer, high rates aren't helping, the debt load is growing, and even, hard to see because of the increase in buy now, pay later. But how do you juxtapose that with the liquidity and froth that's clearly in this market? I mean, GameStop was trading at 17 on Friday night. Then Keith Gill releases a picture of someone playing a video game, and all of a sudden it's trading at $50. Bitcoin is trading at $62,000, not long after Sam Bankman-Fried goes to jail for pretty much the rest of his life. So how do you square that circle?
Yeah, look, here's what I will say. I think after the first GameStop mania, people thought, okay, the retail investor, that kind of speculative Wall Street bets cohort is not necessarily going to continue to participate in this way going forward. And I think what we've seen over the last trading day or so is that we can get the retail investor and sort of speculative traders to really come back into the market in force. So as we think about the dynamics in the market, we weigh a couple different segments. Positioning and sentiment matter a lot for our entry and exit points. Of course, we think about institutional investors, kind of long duration investors, and then faster money investors. We think about, wealth management, high net worth individuals who tend to take a kind of a longer term horizon as well. And then we also have to consider what can happen on the retail side and how quickly that can move. So I don't know how much this can persist, but I will say as we're assessing the state of the market and looking at all of these different components, we do have to factor in that the retail investor can come in and sometimes and really move the market in a big way.
Kate, thanks very much. Great to catch up with you. Kate Moore there from BlackRock. Let's get more now on Amazon. For that, we go back to Abigail Doolittle. Abigail?
Well, we do have some new information, Matt, and right now the stock is down about 1%. Matt Garman has been named the new AWS CEO to replace Adam Selipsky. And based on Matt Garman's LinkedIn page, he has been with Amazon since August of 2006. Most recently, prior to being named the AWS CEO, he was the Senior Vice President for AWS Sales, Marketing, and Global Services. This, of course, all comes on CEO Andy Jassy making these executive changes. So Matt Garman being named AWS CEO to replace Adam Selipsky.
All right, Abigail, thanks very much. Covering all the stocks that are moving for you today. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. Alex Steele, Paul Sweeney, we're here in our studio. Bloomberg Intelligence, we focus on stocks, bonds, commodities, the markets, and we do it with the help of our good friends at Bloomberg Intelligence. 400 research professionals covering 2,000 companies, 130 industries, and we lean heavily on those folks. Coming up in just moments, Federal Reserve Chairman Jay Powell and ECB Governing Council member Klaas Knot, they speak at a special event organized by the Netherlands Foreign Bankers Association. How cool is that? I didn't get that invite there. So when he comes there, we will bring those comments too. Grant Spohr, Bloomberg Intelligence, Global Head of Metals and Mining, on a lot of stuff going on, M&A going on in the metal space. Anglo.
Or want to be
Want
M&A.
to be, that's right.
Yes.
So I'm not sure we're going to get a deal there, but Anglo goes for bold breakup plan and move to fend off BHP. I like the strategy. I like being aggressive here. I like the bankers fees it's going to generate. So we'll get to that at some point here coming up in the next hour. But first, let's go to Mr. John Tucker with a Bloomberg Business Flash.
All right, kind of in a holding pattern ahead of the remarks from Fed Chair Jerome Powell, which we'll carry live here. The major stock average is a little changed. 7 of the 11 major industry groups in the S&P 500 higher right now, being led by real estate. The biggest drag that is coming from communication services. That's where you find shares of Meta Platforms. Right now, they are down 1%. Data this morning showing the producer price index rose in April by more than projected. Tomorrow we get the consumer price index. And Al Husseini at Columbia Threadneedle says the inflation data continue to be volatile.
You can get a lot of short-term shocks in month-to-month data. In Q4, inflation decelerated perhaps a little bit faster than the underlying trend. In Q1, we saw data move up a little bit faster than the underlying trend as well. If you average it out, inflation is still trending somewhere between 2.5% and 3%.
And then meme stock craze part 2, among the most active, AMC, GameStop, more on that in just a moment. Home Depot, same store sales falling 2.8% in the company's fiscal first quarter, bigger drop than analysts were expecting. S&P 500 up 4 points. The Dow Jones Industrial Average, I've been making too much noise over here.
I'm sorry. I was printing something out, and there were headphones on it.
It sounded like you were making a cocktail with a blender. Dow Jones Industrial Average up 71 points. The Nasdaq Composite Index 21 points higher right now. Let's do yields. The 2-year 4 basis points lower at 482. 10-year is down 3 basis points. That's at 445. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. If it's a margarita, I'll take one.
In my defense, Tom puts his headphones on the printer, so when I print something,
of course he does.
Then the printer and the headphones,
That's what the printer's there for.
combat itself, and then I'm whipping around the headphones. Hello, happy Tuesday.
Anyway, that's your Bloomberg Business Flash. Alex and Paul.
This bodes well for the next couple hours. I gotta say though, just looking at the market, it is so boring.
Not if you're a meme stock person.
No, that's cool.
That is bad.
And individual names, and
Yes,
some are
but you're
actually
right, the market
fundamentals
is
are
boring.
interesting. But headline level, it's like,
But
guys.
how about that PPI, that inflation came in? I guess people don't care. I thought that looked really hot.
Well, the idea, I think, is that the inputs that go into a PCE, which is what the Fed looks at, actually were fine.
Oh,
so they think the Fed will have a different kind of
All right.
reaction. But I agree with you nonetheless. Just to have a limited reaction
I mean, if
seems
I had
very
Michael
odd.
McKee in here, a noted economist, I would say, is this inflation we've seen in the first 4 months of the year, is it resurgent inflation? Is it just a little stickiness here? What is it? I don't know.
Right, or is it going to be like I forgot who I was reading. It was like a whack-a-mole. Inflation comes up really strong over here in medical costs. Boom, you hit that down. All of a sudden, it's going to come across over here. Boom, you hit that down, and it comes across.
There's certain elements in that where, it did look good, like airfares. I just paid for a round trip to Paris, and the ticket, I was
going to
surprised.
Paris?
Wait,
I'm not going.
My
daughter's going.
I got
thought you were buying Tom Keene ticket.
But I was actually surprised how inexpensive it was. So.
Fair enough. Fair enough. Well, you could have gone to the Netherlands. So
I think we might be going to the Netherlands.
Jay Powell
right
did.
now. Yes.
So anyway, we want to go to Federal Reserve Chair Jay Powell, ECB Governing Council member Klaas Knot. They're speaking at an event organized by Netherlands Foreign Bankers Association. We're going to listen in part of this conversation right now.
Of the U.S. economy and where Fed policy is right now.
Thank you, Claire. I'd be delighted to. Let me say it's great to be here. Thank you for being here. And Klaas, thank you for this great visit I've had here to Amsterdam. It's a pleasure and an honor to be here. So the U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income, consumers are spending. Generally, households are in good shape financially. They're not over-levered. And so we see a good picture. Consumer spending has held up very well. As well, business investment has been strong. Businesses are seeing opportunities to invest, and that has helped. I would also point to a fairly large influx of immigration into the country over the past couple of years, and those people are joining the labor force. We're experiencing still a labor shortage in many industries, and so there are jobs, and they're going to work and they're consuming. So that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back, and what we've seen is it coming back in gradually into a better balance over the last couple of years. And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019, and that's good. Real wages are now positive, and unemployment has been below 4% for 27 consecutive months, something that hasn't happened in a half century. So, labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into balance, just as we would want. Inflation, it's worth starting with the fact that on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%, so it's down by half. That progress, though, really happened over the course of last year, and particularly the second half of last year. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect continued growth, 2% or better. We expect the labor market to continue to be strong, but to move further and further into balance. And I expect that inflation will move back down on a monthly level, on a monthly basis, to levels that were more like the lower readings we were having last year. I would say my confidence in that is not as high as it was, having seen these readings in the first 3 months of the year. So we're just going to have to see where the inflation data fall out. And I'll stop there with the economy. Thanks.
Thanks very much. We'll be digging into some of that later in the discussion, but now I'd like to turn to President Knot. Could you maybe give us a little bit of a sense of how you judge the state of play in the Eurozone and here in the Netherlands?
Yeah, I think the state of play in the Eurozone is not entirely comparable to that of the US. We just came out of more than a full year of economic stagnation. Now, luckily, the signs of recovery are clearly there. We started off the new year much stronger than we had expected. And if you look at the soft indicators, that recovery is expected to continue into the second quarter, and it's even expected to accelerate in the second half of the year. And this is mainly on the back of ongoing recovery in real wages, ongoing recovery in purchasing power, and strong consumer demand. Now, there are two ways in which you can look at this recovery. Of course, you can say, on the one hand, the economy has proven to be resilient. We've went through quite a number of shocks, monetary tightening, unprecedented, and yet we did not really go into a recession. The sacrifice ratio of the disinflation process that we had to go through was virtually zero. Unemployment did not budge. So resilience was there. But on the other hand, the growth was clearly not as abundant as it was in the US, and that is clearly remarkable. Now, I think there is a multiplicity of factors behind this growth differential, but if you allow me to single out the two most important factors in my view. First of all, fiscal policy. And this was not only about the size of the fiscal stimulus, it was also about the design of the fiscal stimulus during the pandemic. In the US, there was a choice for temporary layoffs, income support, and then rehiring when the economy reopened again. Well, that means that a lot of labor reallocation took place, and we know that such reallocation is very productivity enhancing. But in Europe, we chose a different approach. We chose an approach that was focused on job security. The governments essentially took over the wage bills of the firms. And as a consequence, we froze the supply side of our economy for a couple of years. Then during this period of stagnation, there was a lot of labor hoarding, which means that we have gone through a number of years where there has been hardly any labor or, for that matter, capital reallocation. So we have not enjoyed these efficiency benefits of reallocation as much as the US. And secondly, the economic impact, the negative economic impact of Russia's unjustifiable invasion into Ukraine were, of course, also much stronger on this side of the Atlantic than in the US. We are a fossil fuel importing area, so it meant that this was a very strong negative terms of trade shock, and this terms of trade shock of which we are recovering still also today. Now, on inflation, I think the picture is that I'm increasingly confident that inflation will decline towards our 2% target during the remainder of the year. This is mainly on the back of goods and food price inflation that is coming down. Services inflation has been resilient for a while, but we're now also seeing the first signs of improvement there. And that has everything to do with a slow but gradual moderation of wage growth, which is quite essential, I think, also going forward in making an assessment of inflation risks. But all these developments clearly point toward further disinflation. Also here, an intriguing question is, of course, is there more similarity or are there more dissimilarities with the development in the US? From the onset of the inflation shock, it was clear that the balance of root causes between, let's say, positive demand shocks and negative supply shocks was different in Europe from the US. The US had a much stronger demand component. I think we had a much stronger supply component. Yet at the same time, there was a remarkable synchronicity if you look at the development of actual inflation. So the bump that you've been seeing in the US, the question for us now is, are we going to see such a bumpy development as well? So far, we've not seen any evidence of it, but that's clearly a warning signal for us, also not to come with any sort of premature declarations of victory. All in all, I do believe that inflation is probably less persistent in the euro area than in the US. And that leads me then to conclude that if we manage to continue on this track, if the incoming data continues to validate this development, that it will be appropriate for us to gradually take our foot off the brake, to remove some of the restriction, the monetary policy restriction that we're currently imposing on the economy. The data that needs to confirm this, a lot of that will be available at our June meeting. We will have an additional data point on the labor market coming out next week, the triangulation between wage growth, productivity growth, and profit margins, which is important. Then we will have new projections, and I'm confident, again, that if they confirm the picture, as I just sketched it, that June will be a good opportunity to make a first move in removing restriction.
Okay, very clear hint at June there. We'll come back to whether we could see further moves in July too. But just to draw on some of your comments there, you seem broadly confident that inflation is going to prove less of a problem in the Eurozone than it seems to be at the US at present. You know, we've seen quite a reasonably high PPI reading today from the US, Chair Powell. Some people have said that looks hot. What do you think of today's reading? And more broadly, is there a risk that inflation becomes a lot more of a problem in the US than it is elsewhere?
So we had a producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. The headline numbers were higher, but they were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year, where we had historically fast disinflation. Inflation came down by two full percentage points last year. Why did that happen? It's really two forces working together. One of them is just the reversal, the unwinding of the pandemic-related supply and demand shocks. So that we thought we would always get that. We thought we'd get it in 2022, and we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions really to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy and makes room for the supply side to heal, but also lowers demand and ultimately lowers inflation. So I do think those two have been working together. And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still, businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortage is alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up on it yet at this point. I also think that having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate.
And just to bring in a question
You've been
that one of our
listening to Federal
members of the
Reserve Chair
audience
Jay
asked
Powell and
earlier,
ECB Governing Council member Klaas Knot speaking at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times is
do you
moderating.
entertain the possibility that returning to the 2% target will not be possible with the current level of the Fed funds rate?
So I think, as I just mentioned, I do think it's really a question of keeping policy at the current rate for a longer time than had been thought. I think by many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is, that could be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
And is there any particular component of inflation that concerns you? A lot of people in the US have been focusing on housing and that segment, but is there that, or is it something else that?
So we think of it in three buckets, the first of which is just goods inflation, and goods inflation was negative for 25 years, mildly negative because, of course, globalization and many goods were manufactured elsewhere and shipped at lower costs. So that, I think, is performing broadly as expected over time. We had very high goods inflation at the beginning of the pandemic because of the supply chain issues. That came down a lot, and I think we expect that. The housing inflation has been a bit of a puzzle because current rents have been low. Current rent increases have been low for some time, but they're not showing up. That's not showing up in rollover leases and in owner's equivalent rent. So, I think what we've learned is that the lags between a decline in market rents and it showing up in the measured inflation for housing services is long. Their lags are longer than we thought. But as long as market rents don't go up, as long as they're going up at very modest levels, it will show up. It's just a question of when. I think our estimate of the lags is there, and so you've got to look at that. That may affect your confidence, but we have to wait for it to happen. In terms of the biggest part of it is services inflation, non-housing services, and that's more than half of the index. And it's less interest sensitive. It's very sensitive to wages and that kind of thing. We had made some progress there, particularly if you look at the market-based aspects of it. But that's the one that I think may take the longest. At the same time, it doesn't need to go to 2%. It wasn't at 2% before the pandemic. You need the three of those to come out in some way that they're at 2%. And I'm confident that we will get there.
Excellent. And just to go back into this theme of divergence, I mean, to summarize your answer, it seems that, you think the geopolitical aspect of the Europe being closer to Russia, and also the aspect of the, I guess, not only the scale, but the design of the fiscal response, are the primary drivers of this divergence that we've seen between the US and Europe. Chair Powell, what would your thoughts be on this? Are there other factors that you think are worthy of consideration when trying to understand why the US and Europe seem quite different economic beasts at the moment?
So I agree with all of the factors Klaas laid out. I would add we're probably also benefiting from a sort of a strictly accounting GDP standard from new workers coming in to a large extent. I think the issue really is, and this is an issue that that the European economic policymakers are very, very focused on right now, is over the longer run, Europe's productivity growth has been about half of the US. And so ultimately all you've got is hours worked, and that's largely a function of population, hours worked and then output per hour. That's going to be your economic activity and growth. And so productivity is really the thing that can enable living standards to rise over time. And there are a lot of theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank-centric system. We've got a very highly evolved financial system. That may be another factor.
Yeah. So plenty of other reasons there that are worth mentioning, I think. Turning back to you, President Knott, you gave a pretty clear signal, I think, that we're going to see a move in June. But a lot of the questions that people have put to us today have, stressed this point of usually there's been this sense that the ECB has been following the Fed, and it's raised a bit of a question mark as to what degree can the policies of, the two major global central banks, with apologies to the Bank of England, how much divergence can we really see? So, to what extent do you feel constrained by what the US central bank does, and would you perhaps be reluctant to cut in July should the Fed want to, stand pat and leave rates as they are for the foreseeable future?
Look, I think if you talk about monetary policy of big central banks like the Fed and the ECB, that monetary policy always takes place in a global context. I mean, our markets are interwoven to a large extent, etc. At the same time, we both have clear domestic mandates that look on an economy which may be 10, 50% open, but it means at least 85% closed economy. So much of our inflation is actually being triggered still by domestic factors. So what we simply need to do is construct our own inflation outlook, for the euro area. And yes, Fed policy is, of course, one factor that has an impact. And if you think about international spillovers, the first things that comes to mind is through the exchange rate. If the Fed were to run a tighter ship than we were going forward, then probably that would lead to some dollar strength and euro depreciation, which of course leads to additional imported inflation. But at the same time, you will also have a spillover effect through global financial conditions. Bond yields internationally are also moving in tandem. If you look at the last few weeks and months, bond yields in the euro area have gone up significantly without there being a true euro area reason for doing that. It was just the spillover from the US. And that effect is, of course, disinflationary. So if you look at the two effects, it's not so clear which of the two will dominate. And it's therefore also not so clear whether the developments in the US will really have a meaningful impact on the inflation outlook in the euro area. I don't think it will change the direction of travel in the euro area that much.
So you'd be willing to cut in July too?
Well, we've been saying all along that we follow a data-dependent and a meeting-by-meeting approach. And I keep repeating here, it is essential what is happening in the labor market in particular, because services inflation is still the main remaining driver of inflation in the euro area. So we will simply have to follow the data as it comes in, both on underlying inflation trends, the labor market, etc. And that's why there is no commitment beyond June. We will just follow a meeting-by-meeting and a data-driven approach. And data, when it comes to the labor market, it's really about the comprehensive assessment of the labor market. It's too simple to just look at sort of contractual wages. Contractual wages are coming down, but one of the problems now is that we have negative productivity growth in the euro area. We had negative productivity growth in Q4. In Q1, again, it seems as if growth in employment exceeds growth in GDP, which means that probably next week we will get another negative productivity growth number. And that means that unit labor costs are actually still going up. And then the question whether profit margins are capable of continuing to absorb these unit labor costs, that's something that we really have to assess over time when we decide on future steps. So nothing, no commitment whatsoever, open mind for anything beyond June.
And just to turn back to the issue of US inflation for a moment, even though there's this sense that we did see a remarkable drop of inflation last year because it was, just so aggressive the year before that there is this sense that, there's still a public perception that prices are very high. How difficult is it to really feel as though you can keep credibility at times when trust in public institutions is under siege? And that's from Jeroen Broekman, who's from Leaders in Finance.
So I think for central banks, credibility is kind of everything, and we only earn that one way, and that's by achieving our mandate for the benefit of the public over time. And also, I would add, a part of that is sticking to our knitting. Don't take on politically fraught issues that are really not our mandate. Do your job and explain as best you can what's happening in the economy. Of course, the economy the post-pandemic economy has surprised everyone. I wouldn't single out any single central bank or group of forecasters. It's just been many things that were not supposed to be able to happen have happened. Nonetheless, we've made real progress on inflation. We're far lower than we were. I would say the risk that at the beginning we were very concerned that the very high inflation we saw might be quite difficult to bring down without a kind of very significant decline in employment and weakening economic activity. That didn't happen. That's just a great result. I think people are unhappy. You mentioned people are unhappy. That I fully appreciate that. And a big part of that, I think, is go to the store. Prices are high. You tell people inflation is coming down, and they think, I don't understand that. You know, the price of all the things that I buy hasn't come down. So, they're not wrong. I mean, they're suffering. Particularly people at the lower end of the income spectrum are very hard hit by inflation from the start, which is why we're so strongly committed to restoring price stability and keeping it in place as long as possible.
And just to turn back to Europe now and to the Netherlands in particular, you know, we're sitting in a venue here that's really testament to the power of trade, for good and ill. In an era of deglobalization, when we're seeing daily headlines about tariffs, and how does the Netherlands as a small open economy, and indeed the Eurozone as a very trade-dependent region, really thrive?
Yeah, that's a difficult question. I mean, it goes beyond saying that this is a development that is absolutely not a positive development for the euro area, and that we watch with a lot of concern. Now, fragmentation is there. The train has left the station. So, I mean, we have to think about sort of the ways that it can manifest itself and what we can do to try to best redress its consequences. There is a sense that international business is actually to some extent more resilient to political fragmentation than we have been thinking beforehand. So that international trade is a little bit like a river that sort of tends to find its way, even if some obstacles are being raised here and there. But of course, the fragmentation, it impedes the diffusion of technology across borders, so that means lower productivity growth everywhere. I would also not underestimate the limitations that it puts on our capacity jointly and internationally to solve global problems. In a fragmented world, suppose we had a global financial crisis again, like in 2008, 2009. It would be much, much more difficult to get the G20 around the table and to agree on a concerted remedial plan as we did in 2008, 2009, think about climate change, etc. What can we do about it? Well, I think in Europe, there is still a lot of untapped potential to at least strengthen our internal cohesion. We're not tapping the full potential of the single market. In many, many places, the single market only exists in a name. We don't have capital markets union. I think we are really doing ourselves a disfavor. We don't have a banking union yet. And so we are missing out on opportunities to strengthen international trade, or sorry, inter-European, I should say, trade and integration, economic as well as financial.
Would you have anything
to
add
we're
on
listening
this
to Federal
topic?
Reserve Chairman Jerome Powell and ECB Governing Council member Klaus Knot speak at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times.
So this is a very, very hot political issue, not just in the United States, but everywhere in the world. And not trade policy, of course, not the job of the Fed. So, I mean, we, as I mentioned a few moments ago, I think we need to resist the temptation to just have opinions on all different kinds of economic policies, as fun as that might be. You know, the elected government has to deal with these things, and they have to deal with the public on them. And they've given us really important assignments, and I think we need to honor the decision not to give us that.
And I appreciate this is also an awkward topic, but it is, you know, it is one that's on people's minds a lot when it comes to the U.S. Fiscal deficits, in the sense that the national debt is forecast to rise by the Congressional Budget Office quite substantially over the next 10 years. Does that make your life trickier as Fed chair rather too?
I don't think it's not that it makes my life more difficult or the Fed's work more difficult, but I think it's utterly non-controversial to say that U.S. fiscal policy is on an unsustainable path. Not that our fiscal position itself is unsustainable, but the path is unsustainable, meaning that we have full employment and we're running big structural deficits, and it's we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. I do hear from elected people on both sides of Capitol Hill and in both political parties that they do understand this. And I think you mentioned the Congressional Budget Office. I think everyone should be reading the things that they're publishing about the U.S. budget deficit and the path, and should be very concerned that this is something that elected people need to get their arms around sooner rather than later.
And you've noticed a lot, you've noted a lot that these supply side benefits that you thought might come in 2021 or 2022 did actually arrive in 2023. Now, what sort of benefits from the supply side do you think we could see in 2024 and beyond?
So I think we probably have realized most of the reversal of the pandemic supply side effects, but not all of it. But I think we could get more sort of the final parts of the supply chains really getting sorted out. As I mentioned, the surveys of businesses, they still say there are shortages. They still say that they have a hard time hiring people, for that matter. So I do think we're still getting very substantial numbers of people coming to the country and going to work. Let me add, immigration also not a policy that the Fed works on or has opinions on, but I'm just giving you the straight economics of it. People come in, they can get a work permit, they are getting work permits, and they go to work and they're paying taxes and they're creating economic output, and there are millions of them. So it's alleviating the labor shortage that we had in the industries that really had it the worst. So I think all of that, it probably helped at the margin a little bit in cooling the labor market off. It's both supply and demand, but we think at the beginning, in the longer run, it should be neutral on inflation, but in the short run, it might have been positive. So I think that's a factor too.
And just to kind of turn to these broader demographic trends, there's been a lot of talk in recent years about how they will impact inflation, whether they have some sort of impact on R star, the kind of, the Goldilocks level of interest rates in the longer term, one might say. I mean, how do you think about these kind of longer term demographic trends and other factors and how they're going to influence where you see this kind of magical Goldilocks neutral rate of interest? So
the R star, for those of you who aren't central bankers who read every word of every story Claire writes about us, R star is really a longer run concept. R star is a neutral interest rate that would neither push up on economic activity nor bring it down at some hypothetical future time when we're at full employment, we're at 2% inflation, and there are no shocks hitting the economy. So think 5-6 years down the road, there's this sort of nirvana out there. Its relevance for current policy making is kind of limited, and I think you need to say that. Really what we're doing in an FOMC meeting is we're looking at the broad effect of the things that we're doing on the economy, and we're asking ourselves, is policy tight enough? Is it too tight? We're looking at what's happening in the economy. We're thinking about lags. And it's not a debate over the level of R star, because that's a longer run concept. Now, and the argument is made that R star will go up, and this is a debate that economists have been having for some years now. But the idea is, between deglobalization and the need to fund the energy transition, and perhaps the need to spend more on military and the aging of the population, bigger deficits, higher, all of that could push up what is a neutral rate. And I think those are interesting debates to have, but ultimately we're not sitting around wondering what the longer run neutral rate is when we do policy. When we make policy, we're thinking today, is our policy delivering what the economy needs to move it toward the mandates that Congress has given us: stable prices, maximum employment.
So would you divorce it? I mean, I think why this has come into focus, if you like, is because now that cuts are being considered in some parts of the world, at least there's this sense in which people are thinking, how low will rates go? Would you see that as part of the kind of R-star debate, or would you want to divorce the two factors of this current cycle and where R-star will end up being?
I think the R-star debate runs in the background, but again, it's a longer run concept. You could, if you wanted to think about a shorter run R-star, that would be more relevant. But that's not the way we think about it. We think about the effect of the things we're doing on financial conditions more broadly and on the economy. And how is it affecting the economy and why? And all of those things lead us to believe at this time that policy is restrictive and that it looks like it will take longer for us to become confident that inflation is coming down to 2% over time.
And how is this debate occurring around the table in Frankfurt at the ECB about longer run interest rates, or even, where are we going to end up? What's the rock bottom for this cycle?
Yeah, I mean, that's, of course, a difficult question to ask because there are so many moving parts here. But what I would say is that if you look at the likelihood or the likely nature of the shocks that will hit us in the future, we came out of a period in which we had globalization, which was a slowly moving positive supply shock, ever more goods for ever lower prices coming from the rest of the world, which meant that for almost 10 years, we continuously had to approach our inflation target from below. We had a low inflation problem. Going forward, with fragmentation, with aging of our societies, in my view, it's more likely that the shocks hitting our economy will actually be of the nature of negative supply shocks, not positive supply shocks. And if you think that through, that means that probably we will have to approach our inflation target more often from above than from below. And that probably suggests that we are not, at least I don't regard it very likely, that we will move back to the time in which we had a continuous sort of our fairly persistent low inflation equilibrium with very, very low interest rates. We probably have to, on average, run a slightly tighter ship because of the nature of these shocks that are currently relevant to our economy.
And just to come back to something that I think has been kind of in the background here for quite a lot of the discussion about high interest rates taking possibly a while longer till they have the desired impact on some pockets of the economy. How do you see that? Is this a legacy of this very low interest rate era? And how do you really address that when it comes to monetary policy? That is there just going to be this lag from now on that didn't exist, say, relative to pre-2008?
So I think if you look at the bigger picture, we've seen, the labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy's working. It's weighing on spending. It's weighing on interest-sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy. As I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer And that's how we're thinking about it.
And I mean, you note about housing and about the standard model in the US being I think I'm right, the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too, but I imagine with shorter
10, 15,
duration.
An average mortgage, I think, has an average maturity of like 16 years. Of course, that's a little bit endogenous because of the low interest rate period we had for so long that, of course, mortgage holders tended to extend the maturity. So now, lately, it's been coming in a little bit. But still, we have a lot of fixed rate borrowing in the Netherlands, and that has, of course, also mitigated the impact of the monetary tightening, which has been stronger in those areas where there is more variable rate borrowing. But in general, I would say 85% of all financial intermediation in the euro area runs through the banks. So when you look at monetary transmission in the euro area, you have to look at credit. And credit growth has more or less come to a halt. As a consequence, we increased policy rates by 4.5% within 14 months. Credit growth came to a halt. That was a feature of the policy, not a bug. And credit has been